Oh my gosh, it's not even Halloween. They gave me a Christmas cup today. The one good thing I'll say about all this spend on AI, it is something that creates a lot of jobs. Like, you want to talk, these facilities they're building, I don't know if you guys have seen them or looked them up, they're ridiculous. I'm not going to play that game, man. I'm not going to play that game. It's just too much stress, too much distraction. Dan Now's made a massive call yesterday talking about you'll see 30 to 50% correction crashes in many AI related names next year. Let me see if all of my players can win like MVP and all these different things, right? Let's see if I can break new records. It's a game, right? Game of money. For me, I love the game. I love playing this game, right? I love the great markets, the bad markets, the kangaroo markets. I love it all. I love it all. Remember the saying, markets can remain irrational longer than you can remain solvent. You gotta be flipping my flapjacks. We are in busy times, folks. We got earnings after earnings hitting for many of the biggest companies in the world. I'm trying to keep you guys up to date as well as I possibly can in regards to all this stuff going on, my perspective, opinions. A lot to get into in this video here today. Amazon just came out with earnings here in the past hour. Stocks moving up significantly. Congratulations to every single person out there that's an Amazon shareholder. I don't care if you got a share, 10 shares, 1,000 shares of Amazon. Based upon what I have in the public count tomorrow will probably be, my guess is anywhere is between a $30,000 and $60,000 day. If the stock goes up $30 a share tomorrow, we'll be up $46,000 on Amazon stock. So we'll spend some time talking about Amazon. Then I want to talk about big tech in general. We have 6 of the 7 big techs have now, the 6 of the 7 Mag 7s have now reported. I want to share my perspective and opinions on who looks the strongest and weakest of these companies, okay? From there, I'm going to show you my entire possible buys watch list and talk about which stocks I view as the best opportunities and which ones I'm waiting on, so that should be fun to get into. From there, I want to react to this video from 57 minutes ago. Amazon's magic number is AWS Growth. Looking forward to reacting to that one. I want to react to this one, Gene Munster, on his takeaway from the Meta's investor call. And then this video here, looking forward to reacting this one around Meta and the fast money traders sharing their perspective and opinion. And I thought this would be a great time to talk about Meta. Obviously, with the big downward move, a lot of people are looking at Meta stock and they're like, wait, is this a great deal right now? Is this like easy money? Is this kind of like all the money's been made in Meta stock? Those sorts of things. So yeah, I want to get into all that. There's one thing and one thing only I need from you guys. If you could just hit that little thumbs up icon, that would mean the world to me. That's all I need from you. And thank you every single person that's already done that. Additionally, if you're not subscribed to the channel, you might want to subscribe. We just hit a new all-time high subscribers in the history of the channel, so I appreciate y'all for being here. Pinned comment down there today if you want access to my entire library of premium courses, access to my private Discord chat, exclusive weekly videos, all that good stuff. That'll be pinned comment down there. We're now up to 2,735 members. I'm seriously considering closing the group to new members in either November or December, and then reopening at some point in time in 2026, because it's just been overwhelming. Like back-to-back days, we've had over 120 applications to private group. Usually we have 15 to 25. And I don't have a big team that works for me. I only have a few people that help me run the private group. I have my developers that work on 1000xstocks.com, right? And new features and things like that, right? I have like one person that helps me with Patreon, one person that helps me with the YouTube clips channel. I don't have like some massive team. I got just like a very small team of probably like 10 people or less. So yeah, like the private group, the demand's been overwhelming. So I might shut it down to new members next month or in December. So if you want in there before I do that, there'll be pinned comment down there. Okay. Alrighty. So amazing's on. Let's talk about Amazon first and foremost. Okay. So when it comes to Amazon, I'm going to show you their report in just a moment, but let me just put it simple. Okay. You want the 5-second answer? Amazon's a buy. Amazon's a buy. And the most important metric that Wall Street really cares about, AWS growth, is accelerating for the company. We've now seen it several quarters in a row of acceleration of AWS growth. We're now into the 20s when it comes to AWS growth, which is significant. Remember, AWS is by far and away the biggest cloud company in the world. So when we're talking about that business is growing 20%, that's substantial. Big dollars, right? It's one thing if you're a little cloud company just growing and like, we grew, revenue 35% last quarter and you got like these little small numbers. Okay. When you're Amazon, when you're the big dog and you're growing 20% plus, that's huge. So, just something to kind of keep in mind there. If they accelerate that Amazon Web Services growth, that AWS growth to the mid 20s, you'll see Amazon with a 3 in front of it quick. So keep that in mind. If they could go like 24, 25, 26% AWS growth, you'll see a 3 in front of that stock. That, there's so many businesses inside Amazon that matter so much to that stock, but Wall Street cares about AWS more than anything out there because it is a profit machine business for them, right? So yeah, Amazon's looking good. Now, as far as big tech in general, the Mag 7 specifically, right? When we look at this overall, so like Tesla, for instance, their main issue is their revenue growth is really slow, and then their earnings per share is going down quite, substantially, right? Even if you look at like adjusted EBITDA, all those sorts of things. So there's no debate. Tesla's by far and away the weakest, but obviously people are really excited about potential long-term things for the company, right? Now, when it comes to Meta, the revenue growth is insane. Like Meta's got the second strongest revenue growth of any of the Mag 7s. The only company that's growing more rapidly than Meta on the top line is guess who? Nvidia. That's it. And so Meta's, in a great position. The issue with Meta is Zuckerberg's really, really running up those numbers when it comes to expenses, right? And let me show you an illustration here from the private Discord chat. I posted something very important last night here in the Meta chat that I want to show you. Right here, okay? I posted this 1:28 a.m. I was still up. I posted this just so you guys could kind of see this, right? So revenue growth versus cost growth last 3 quarters. Revenue growth for Meta here was 16%. Cost growth was 9%. Revenue growth 22%. Cost growth 12%. Phenomenal, right? Now, revenue growth continues to accelerate quarter after quarter, now up to 26%. That's amazing. But look at the cost growth was out of control this quarter, 32%. So what we need to see in future quarters is they have to get this number under control and get that revenue growing at a faster clip than this. If we can do that, then you'll see Meta at $1,000 next year. So that's the big thing that's very, very impactful there, and something you guys got to keep in mind here. Now, when it comes to Google McDougal, very solid B+ income statement from Google here, right? They also are having expenses are getting a little high for Google as well. Like, look at G&A for the company. G&A roughly doubled year over year, so that's a big number there. R&D, research and development, that was up huge as well. Obviously, they're spending a lot because they think they're going to be able to make a lot of money in the future. But Google McDougal, definitely expenses high. AmazingZone, B- grade for AmazingZone here today. Total sales growth looks phenomenal. They grew revenue $22 billion roughly year over year, which who else can do that? That's insane, right? But the main issue when it comes to Amazon is they had this other basically expense here of about $2.8 billion that hit them. So technology and infrastructure was a pretty high number too. That was up about $6.7 billion year over year. So they ended up getting a B- grade in the end from Amazon. Mr. Softy shows why they're one of the kings, right? Grade A income statement here, phenomenal numbers. And then Apple, phenomenal numbers. They were also a grade A as well. They barely missed an A+. If they would have just had faster revenue growth, I probably would have given them an A+ overall for Apple. So good numbers out of Apple, or I should say great numbers out of Apple, great numbers out of Microsoft. And then the others are solid, but they're not like amazing, right? And then I'm sure we'll see amazing numbers out of Nvidia, right? So the moral of the story is, who impressed the most this quarter? Listen, it depends on if you're looking at it from an overall standpoint of like profit growth, margin growth, those sorts of things, or who impressed the most as far as revenue growth. Who impressed the most as far as revenue growth, that crown would go to Meta, right? 26% revenue growth. With how big that business is, to be reporting 26% revenue growth in this environment is unbelievable, right? Like, people didn't think that company could still be reporting this sort of growth. Like, that's insane. The number 2 company that impressed the most when it comes to revenue, I would say, is Amazon. Amazon, the fact that AWS is now growing in the 20s again, phenomenal. Who impressed the most as far as an overall income statement? Though that would definitely go to two of the kings of Mag 7, right? Which is Apple and Microsoft. And then we're going to see the last king of Mag 7 report in a few weeks from now, and don't be surprised if they report an A+, right? If they don't actually report an A+, don't be surprised if Nvidia stock goes down. Keep that in mind. Like, Nvidia has to come in with like this perfection all the time now to continue to go up. So that is just something to kind of keep in mind there, right? No, my possible buys watch list here. Which stocks am I most excited about, least excited about, all that good stuff, right? Okay, so let's just start it at Kava. Kava first off, okay? So when it comes to Kava, this stock has been wrecked. I mean, look at this stock. Year to date down 53%. unbelievable. And it's not the only restaurant stock that's had trouble overall. There's been plenty of them. If we pull up a year to date here. So let's compare them against CMG, which has been going through it also. Let's compare them against Starbucks. And let's pull up my beautiful cake. I love cake. Should I pull up Texas Road? I'll throw up Texas Roadhouse also. Okay, that's been a great company over the years. And then you know what? Let's throw up. I mean, we could put up McDonald's. Okay, let's put up McDonald's as well. Okay, and obviously these companies all compete in a different way. Now, McDonald's has actually been the best performer year to date. The whole sector has, how do I put it nicely? It sucked. Okay, the whole sector is bad. Like this has not been. Like, if you're looking at it from a short-term perspective, like 2025 has not been the year for food-related companies, okay? It doesn't matter if you're quick serve, if you're a sit-down restaurant. Look, they're all bad. I mean, the only two that are gains this year, the only two you have made money in this year, right, is McDonald's and Cheesecake with a 1% and a 3% gain. That just shows you how weak this sector is overall, right? And it definitely shows you who's the most quality in the space as well, right? McDonald's is always the most quality, even though their food's not the most quality, right? They're always the most quality because of their business model and the way they structured it. And Cake's always most quality because they got two restaurant chains that have massive growth, and then they just do a phenomenal job operating those, right? Texas Roadhouse is extremely well run. I've always been impressed with Texas Roadhouse, and I have been a shareholder in the past. I just haven't been for like the past year or so. But Texas Roadhouse, that stock's down almost 9% this year. Starbucks, even though that one had already been getting hit, it's getting hit more this year, down about 10%. Chipotle, down 45%, and Cava down 53%. So when it comes to Cava, obviously it's not a stock I own, but I have it on my watch list here. I might possibly buy it. What am I thinking about getting in Cava? Okay, listen, first thing is if I buy Cava, there's always a potential I never buy this stock, but I actually kind of like it. The one thing that scares me with Cava, by the way, is making sure they do a great job with the operations of their restaurants in all these different cities they're going to be expanding into over the next 5-10 years, and making sure they have that unlocked. That's, people assume like, oh, that's just so easy to do. You just build thousands of restaurants and boom, they're up. No. Ask anybody from the restaurant industry. They'll tell you it's brutal to even have 2 or 3 locations and have them be on the same quality levels, right? Never mind having 100, 1,000, 10,000. It's unbelievably challenging to have them all be extremely consistent, right? McDonald's can be consistently average and like they get it done, but it's, like that Big Mac or that double cheeseburger, it doesn't matter if you're in, Atlanta, Georgia, or you're in Huntington Beach, California, like it's going to be the same dang thing, the same taste, right? Chick-fil-A, very good quality at Chick-fil-A, but doesn't matter where you're at. You could be in Charlotte, North Carolina at Chick-fil-A. You could be in Seattle. I don't know if they have Chick-fil-A's in Seattle, but it's going to be the same quality. Cava's got to do that, and that's very difficult to do. As long as I can get more confidence around that, I can start buying the stock. But when will I start buying the stock? If I do, I'll tell you exactly when. I would start a position in Cava likely at the beginning of 2026. Here's why. Okay, look at Cava's stock price and what do you see on a year-to-date basis, on a 6-month basis? Like, no, let's pull it back all. Okay, we can pull it back all the way to when they went IPO, back here, roughly, right? And then shortly after they went IPO, right here. Then they had this unbelievable run, that really started kind of the end of 2023 all the way into 2024. The stock goes all the way up here. It's insane, right? So then we pull up a 1 year, the stock's down 59%. Year to date, the stock's down 53%. 6 month, the stock is down, if TradingView works, 41% in the past 6 months. The past 3 months, the stock's down 40%. The past 1 month, the stock is down 8%. The past 5 days, the stock is down 17%, right? So what do you think is going to happen with Cava stock? Cava, whatever we want to call it. Here's what's going to happen. You're going to get likely tax loss harvesting in it, especially if their so they're going to report their next quarterly numbers next week, essentially. If that quarter is not good, the stock's going down more, and you'll get an unbelievable kind of avalanche of tax loss harvesting in Cava that will basically go all the way to about Christmas. Brutal. Because people will look at it and they'll be like, the earnings are not good. They could get even worse. The stock's just going down. I need something to write off my Meta gains with, or my Tesla gains, or my Palantir gains, or whatever, right? That they sold for profits. And so they go ahead and sell a position like Cava that's been doing very bad. And remember, the thing about Cava is that's been historically, which isn't a very long history, but like the last couple of years, it had been a very rapidly growing company. Revenue skyrocketing, same-store sales skyrocketing. All of a sudden, that slowed down to a standstill when it comes to same-store sales, right? So now people are going to look. And that's the same, you got to understand, that's the same group that would buy a Cava that would buy a Palantir, that would buy a Snowflake, that would buy, an Amazon or whatever, like growth companies, an AMD and Nvidia. And so many of the growth companies have been doing unbelievable this year. And if you've taken any profits on those stocks, they're big profits, huge profits. And then you're looking and you're like, crap, the tax man's coming for me in April. What am I going to sell before the end of the year to hopefully offset some of those gains? And then you got a Cava in your portfolio that you're down 58% on, right? And you're like, there it is. Bye-bye, Cava. And then that doesn't mean you stay out of Cava forever. You might come back in Cava in 2026 or 2027 or something like that, right? You're just kind of like piecing out for now. So that's my thing. If I do start a position in Cava, I probably won't start it, honestly, until next year. That's probably what would happen there, right? RH, ooh boy, RH. So that's another one. Look at this. Oh my gosh. Oh, brutal. RH stock year to date is down 55%. Unbelievable how bad that stock is done, right? Absolutely unbelievable. RH, another one that I don't want to go into RH anytime soon. That's another one, like if I'm going to buy RH, it's probably going to be 2026. I'm just like, no. Like, why would I want an RH right now? Like, that's another one. If people need something to write off some losses against, you own RH, out. The high end of the housing market still not in a good place. Mortgage rates are still not coming down. They're still in the sixes. So, yeah. You got the tariff mess, although that's getting a little more clear. I don't know, man. Like RH, if I would step in RH, it'd probably be next year, probably be 2026, right? Which that will be a year before you know it. We only got 2 months left in the trading year, and we got the holidays, we got Thanksgiving, and we're about to have Halloween, we got Christmas, we got New Year's. Like this 2 month span just flies by, right? So before you know it, we'll already be in 2026, and maybe I step in on a Cava and an RH. Bath and Body Works. This one, I actually really like it. Obviously, it's not the, most amazing, growth business model, but it's just a very consistent, good, profitable beast company when it comes to Bath and Body Works. Check this out. So, Bath and Body Works. We're looking at 1000xstocks.com here. Check this out. The stock trades at a forward P of 7, a 2-year forward P of 6. Like, it's unbelievable, right? And yeah, it doesn't have the most revenue growth. Like next year, revenue growth probably going to be in the 3 to 4% range. Like, put me to sleep. But you're paying like nothing for this company. And I actually don't think they're like, there's certain companies that if they're at a 7 PE or 6 PE or something like that, I look at them and I'd be very, cautious, because I'd be like, wait a minute, what's going on here with this company? Like maybe they're about to get disrupted or something like that. Bath and Body Works, who's going to come in and disrupt them? Like they sell soaps and candles, right? And they have a very successful business doing that in malls all across the United States of America, right? And then they have an online presence as well. Like, there's as much competition in that space as there will ever be in that space, right? Like, who doesn't sell soaps and candles? But at the end of the day, they do it. They do a great job of it. Do a great job running their stores. It's always impressive. Their stores are always in great shape. They always look extremely presentable. Their employees, I've been in Bath and Body Works 100 times probably in the past 10, 15 years. Their employees are always nice, good, take care of you. If they see you have too many soaps in your hand, they help you out, get you a bag. It's an impressive company. Not the most exciting company, but remember also, we've been in a very hyper bull market, right? All these stocks rolling. Eventually, people are going to start looking at value and dividend stocks as soon as the stock market starts to cool, right? And maybe the stock market's already starting to cool, or maybe it starts to cool in 2026, or maybe it doesn't start to cool until 2027. But I can promise you, there will be a time, I can promise you, when people start to look at the value and dividend stocks again, right? And that's when all of a sudden a company like a Bath and Body Works starts to shine again. So, but am I in a rush to buy that one? No. Because not like growth is just going to magically skyrocket for the company. It's not that sort of company, right? And I'm like, oh, I got to miss out. Like I got to get FOMO around the stock. And additionally, that's another stock that's perfect for tax loss harvesting. Like, is it not? Like anybody that's bought Bath, look at this. Anybody that's bought this stock really in the past several years is down, right? I pulled up a 5-year. Bath & Body Works stock is down 7% the past 5 years, ladies and gentlemen. If you bought this stock at any point in the last 5 years, you're down on it. That can't be good to go into year end, right? That cannot be good to go into year end. So something to keep in mind there. Whirlpool stock. This is another one. 2026, I might buy this one. Another stock that's been obliterated. Look at this. 5-year chart down 61% on Whirly Whirl. 1 year, 30% down. Year to date, 37% down. It's been ugly for Whirlpool. We know no one's been moving, right? Everybody's been staying put. I think that starts to reverse in 2026 and then builds in 2027, 2028, and people start actually moving again. And I think that's going to benefit Whirlpool, not just for like the cool thing about Whirlpool and this thing that really interests me about Whirlpool, because I don't usually like these like commoditized business models, which appliances is kind of a commoditized business model. But if you're ever going to buy commoditized business models, you want to buy them when those stocks have already been like on a multi-year downtrend and they're just wrecked, right? That's when you want to get in, when everything looks bad in that industry. Then you build your position and then you hold for 2-3 years, right? And then you peace out. When times look great again, that's when you peace out, right? Those are not stocks you really want to hold over a 5 or 10 year span. But if you get in them at the right time and they're just beating down dogs, right? No one wants peace. And that's a perfect example. Whirlpool. No one wants Whirlpool stock. No one. No one. And you build that position, and then the company starts to have a multi-year run where their business gets better and better and better, right? Which is, my opinion is Whirlpool's business will be better in 26 than it was in 25. And in 27, I think it will probably be substantially better than 26, right? In 28, it'll be even better. So I think they got a multi-year run that starts in 26 of the business getting better and better. And that's why I'm interested in potentially starting a position in 2026 for that stock. But, you know, I'm not in a rush. I'm not in a rush on a lot of these stocks, these sorts of companies, right? Amazon, you know, is Amazon still a buy tomorrow if the stock goes up $30 a share? Guess what? Yes, it's still a buy. It's absolutely still a buy tomorrow, okay? You know, my Amazon projections, you want to see my Amazon projections to have I showed you guys those before? I don't know if I have. So let me pull up my Amazon projections here on 1000xstocks.com. So load save companies and Amazon. Load data and watch this. So boom, there's all my data loaded from my Amazon projections. On 1000x now we have ability, you can just save it. My bull case gets the stock to 500 plus likely in 2029. Right now it's in the 200s, right? Base case has the stock getting to, we can call it low 400s to about $500 a share in 2029. And my bear case on the stock still has a company doing pretty darn well. And the stock still would be probably about a $350 stock plus, right? So it doesn't matter which way you slice it, Amazon is a buy. Cheesecake's a huge buy. I spoke about Cheesecake very in depth. I think on this channel, Jeremy Lefebvre Makes Money, I think on a video I posted like 2 days ago on the channel here. So if you want to hear me talk, you know, in depth about cake, I love that one. Planet, the issue with the Planet, this government just sucks and they keep continuing to be in the way of all these stocks in this industry. If the government can ever get their act together, these stocks going to be on a massive multi-year run, but as long as the government stands in their way, it's just a brutal business model, man. Brutal business model when the government's working against you year after year, right? Nike, I love Nike at this valuation. It's a beaten down dog stock, right? You know, it's another perfect one that honestly, is it suffering from tax loss harvesting? I think so. I think likely, right? Like if you bought this stock at any point in the last number of years, you're down huge. The only way you made money on Nike stock is if you happen to just buy it in that April dip when it was in the 50s, and that's it. Like that's a very small amount of people have actually made money on Nike stock. Most have lost money on the stock for years, right? And so you need something to write off some gains against. There you go. Adobe, I like Adobe. CRM, I really like CRM. And then Google McDougal, even though it's been moving up and up and up, and that stock's been on fire this past 6 months. Look at the 6-month move on Google McDougal, 76% gain. I'm a happy Google shareholder. That one remains a buy. Let's react to some videos.
Roth, MKM, Rohit, 33.
Hope you guys enjoyed that piece right there, by the way.
Dollars here in AWS revenue. And, operating income for AWS looking pretty solid, considering the layoffs that they're planning as well. Is this what the street is excited about here?
Yeah, I think the magic number is 20% year-on-year growth. That's the fastest AWS growth we have seen in several quarters, and we expected AWS to accelerate when we heard what.
Not only is that the fastest growth in several quarters, I think that's the fastest. Don't quote me on this, but I think that's the fastest Amazon Web Services growth since like 22. But I could be wrong about that. But I just think it is.
From Google, what we heard from Microsoft, with all the cloud and AI cloud trends. And so the bogey was high. And I feel AWS jumped over a higher bogey. And that's why the stock is up and should stay up into the market tomorrow.
What more do you need to hear? Do you think investors need to hear for this to be more than a one-day pop, on the backs of those who were underestimating perhaps AWS? What is a narrative shift going to have to consist of if the stock is going to continue to climb from here?
I think it's about the combination of CapEx and their leading indicator. They'll probably talk about both CapEx and performance obligations. AWS has reported RPO, the leading indicator in cloud growth, accelerating over the last few quarters. How fast that's growing is something that I would keep an eye on the call. The wider the gap between revenue growth and RPO growth this quarter, greater, more bullish people will be. And second is obviously CapEx. They are at about $120 billion in trailing 12-month CapEx, and how high that goes. Next year, Street is around $127, $128 billion. That number already feels a bit too conservative. Yep. How high that CapEx number are they willing to drive? Clearly, it's going to be higher. Whether they give any indicators may put a damper on the stock near term. But again, they are the leading cloud company, and I think accelerating growth is probably putting a lot of kind of bearish narrative to rest.
Now, to push back against what that gentleman just said there, listen, he's basically kind of making a case that, maybe investors might sell the stock if Amazon has bigger CapEx numbers and those sorts of things, and kind of could hurt the stock price short term. Listen, in regards to Amazon, no. Like, that company, they get a pass on spending. People trust Amazon. Like, if they're going to spend crazy numbers, people trust they're doing it for a good reason. I think Zuckerberg has a little bit more trouble. People, when he starts spending heavy, people question it more often, right? But Amazon, since that company came public back in the 90s, like, people they always give Amazon a pass. Like, they believe, like, if they're spending the money well, and they're going to make way more money off of that spend. So Amazon just always gets a pass.
Holiday quarter, and we have that guidance. If you had told me 10 years ago, it would be 18, 19 minutes into an Amazon report looking ahead to Q4, and we wouldn't have talked really about retail yet, I'd have gone, huh? So how much does retail matter here? The amount of discounting and shipping costs that Amazon's going to have to eat to drive the top line growth there in the season?
I think during Q4, to some extent, they tend to give a wider guidance for operating income that is expected, given the wide range of outcomes typically they see from a retail perspective. Having said that, I think retail is in this kind of a long-term shift of profitable growth. We started that at some point in 24, and that kind of continuous shift in controlled investment and ongoing improvement in profitability driven by advertising and retail, that has just started. So we like profitable growth in retail and plus accelerating growth in AWS.
How do you read
So something I've been thinking about recently is OpenAI, and they're going to push hard into e-commerce, it looks like, in 2026 and beyond, right? And we see all the partnership with PayPal to help run payments and use them as a digital wallet, all that good stuff, right? But I was trying to think, like, could OpenAI disrupt Amazon or Shopify? And because those are two stocks I own. Amazon's a massive position for me in the public account, and I think it's the third biggest position. And then additionally, Amazon is a substantial position in the Patreon portfolio, in my private portfolios. And then when it comes to Shopify, that's a big position for me in the Patreon portfolio. So I was trying to think about that. And at the end of the day, what I see with OpenAI and them pushing into commerce, I think if anything that's going to benefit likely Shopify and potentially Amazon, because at the end of the day, like all those orders have to be fulfilled. And from my understanding, OpenAI is not going to go building massive warehouses and try to house inventory and all that stuff, right? And so I think if anything, Shopify could benefit big from that. I think Amazon could end up benefiting in the end, and then other companies could benefit as well. But it doesn't look like OpenAI wants to become an Amazon, right? OpenAI has their hands full with spending aggressively for their AI opportunity, right? Like, I don't think all of a sudden they want to start buying land all over the place and building massive warehouses and adding hundreds of thousands of employees. Like, Amazon has over 1 million employees, right?
Advertising growth, especially in this environment where targeting and organizations with data seem to be doing better. And I'm thinking about both Meta's results and Alphabet's results in the advertising category yesterday. How does that position Amazon heading into this holiday season versus its competitors?
I think Amazon, in my opinion, is redoing their complete ad stack in a way that...
Oh, come on, Chick-fil-A, just stop it. Oh my gosh. It's not even Halloween. They gave me a Christmas cup today. I thought something looked a little too joyous about this cup. Come on, man. That's just wrong.
About a couple of years back, they were only focused on the bottom of funnel, converting the user who's trying to buy on Amazon, showing them the right ads of the right products at the right time, and hoping that they would buy more of that product. Now, with Prime Video, with Amazon DSP, and a lot of partnerships with companies like Pinterest, Amazon advertising is a much more bigger, complete solution where brands who don't sell on Amazon, think of car manufacturers, think of insurance companies, they consider Amazon as an ad partner because you have Prime Video and you have various different one of the richest cohort of internet consumers looking at your product right now. So I feel they're cracking the problem of advertising in a way that perhaps even Google and Facebook haven't, and they have the data and the AI tailwinds to do even more.
Yeah, Amazon's going to continue to build that ad business out substantially. And the thing you got to understand about the ad business, specifically with Amazon, is that is like a straight profit business. Like ads are always like one of the best business models you could ever be in. Ask Google, ask Meta, right? Incredible. And so that ad business continues to scale and build out. And like I said, that's straight profit business. Additionally, I've been very impressed with like the Thursday Night Football now on Prime. Been very impressed with that. The presentation they're now doing, the whole show they have. Like Amazon's really starting to get it in terms of like putting on broadcasts like that, getting into sports. Obviously, they're not going to get into everything, but a few things here and there, which then they can show ads, continue to build out that ad business, right? Maybe even get people to shop directly through ads, through the TV, through those commercials and things like that. They're doing a lot of innovation when it comes to that. They also showcase Amazon Web Services during those broadcasts because they actually have a way you can watch the game, which is like a totally different way of watching football. You kind of watch it from an aerial view, and it'll basically like show you the routes the players are going to do. And sometimes it even shows you like odds and probabilities, like this guy's going to blitz or this guy's going to do something fascinating. And so they're finding ways to help the e-commerce business build their ad business through this and highlight Amazon Web Services all in one. It's brilliant, absolutely brilliant. So, yeah, I'm very happy Amazon shareholder. Let's talk some Meta stock, eh?
Been listening in. He's the managing partner at Deepwater Asset Management. Gene, I want to start off with Meta. So you think that you figured out why it is down? Why?
Yes, Melissa. I guess the answer was clearly in front of us when those numbers came out and the stock gap down. It's just a simple dynamic between revenue growth and expense growth. And if we rewind to the past 2 years, Meta has grown revenue faster than expenses by a wide margin. 2024 revenue growth about 23%, expense growth about 8%. The first 2 quarters of this year, revenue growth 22%, expense growth 12%. They report their September quarter with 23% revenue growth, but expense growth of 32%. And throwing insult onto that is the commentary about the third-party CapEx spend for next year. And this aggressive is the word that they're spending substantial increase. Expenses related to that. We're probably going to see something like 18% revenue growth for next year for the top line. The street's at 16 right now. but probably 18%, and probably expenses growing north of 30%. And so essentially the script that we've seen with Meta over the past 2 years got flipped. And I think it's just that simple. If you look across the board at Zuck's ambition around AI, what he's trying to accomplish, look at their engagement. I mean, just like profound engagement growth, accelerating engagement growth. 43% of the world uses their products on a daily basis. Those rate of usage is accelerating. So it was a great quarter with the exception of that dynamic, Melissa, and I think it really stung investors.
You know, Gene.
Okay. Before we go further here, there's something very important that happened for AMD, I thought, in those Meta results. And let me find it. I posted it here in the AMD chat, which is always a busy chat. Let's see, where did I post this thing? This chicken wang. I know I posted in the AMD chat. Where you at? Where you at, baby? Where you at, baby? Come on. I know I posted it somewhere here. Let's see. No, I must have posted in the AMD chat. Did I not? I think I posted it here. Oh, right here. There we go. There it is. Okay. From yesterday, I posted at 120. Meta just took the CapEx range for this year up on the low side and said CapEx next year will be notably larger. That was their words, notably larger. Bullish AMD 2026, right? So, but yeah, there's definitely people worried about Meta spend, right? And Zuckerberg going too crazy again with the spend. And listen, it's actually a fair question. That's why I think Zuckerberg's got to get that expense line item under revenue. If they can just grow revenue, like shareholders will have no issue as long as they're just growing that revenue percentage higher than expense profiles going up. If that expense profile keeps going up and revenue's not up as much, that's where people start to throw a fit and say, come on, Zuckerberg.
This is one, again, I saw your notes earlier. You're kind of confounded. Microsoft, similarly. When I look at the downtick in earnings growth, though, for 2026 for Meta, I mean, isn't that the sort of thing that you would probably expect for the stock that's outperformed pretty dramatically, over the last 2 years or so to kind of take a pause?
Well, a pause is understandable, but I think that shift, that expense shift, that was something new. Like a pause to me is they've got good numbers, they beat the numbers. That one-time charge that people are talking about, that $15 million tax charge, that's a nothing. Just throw it out. Doesn't matter. Sure. But so I think, Dan, that it's I'm trying to look at like what was incremental. I could understand if the stock was down 3% on good news. That's to me taking a breather. But down 8, 9, 10%. Investors are trying to just recalibrate, I think, something bigger. And again, that dynamic around them going more to cloud. Now, I'd also point out, like around the ambitions and around AI, and I'm all in on this being more transformative than where I think high expectations are. But Zuck basically is setting himself up to be the most optimistic of any of the big tech CEOs, as evidenced by their increase in CapEx. So it's going to be up. The street's looking for 40% growth right now for 26. They didn't give detailed guidance around that, but it's probably going to be up more than 60%. And if you look at what Google just guided up, their CapEx, and imply that for next year, they're going to be up like 25%, and Microsoft and Amazon around that. And this one comment kind of stuck out to me. He said, we're building our AI infrastructure for the most optimistic, that was his word, the most optimistic case for AI. And I think that's the right thing to do. But that is a little bit unsettling when he talks about the most optimistic case we're building for. And so I think, Dan, that's kind of playing into it. I think it's more than just had a good run and kind of taking a breather. I do think that ultimately he's on the right track. Like, I fully support everything that's going on. I think that the stock is going to reverse these losses in the weeks to come.
Oh, no,
Keenan, Karen, thanks for being on. How quickly?
No doubt they're going to buy Meta up. Yeah, and the other thing I'll say about this, I do think significant for everybody that's, wants to be a long-term shareholder of Meta or isn't a long-term shareholder. Listen, something big is going on here. Is Zuckerberg spending a fortune? Yes, no debating. Okay. Look at Meta's revenue growth trend. They just came in with 26% revenue growth. They're one of the only companies in the world that it's actually spending aggressively on all these chips and actually getting a great return on investment, and in terms of at least seeing major revenue growth, right? Like you look at Meta's revenue growth ever since, go back all the way to 2023 and look at Meta's revenue growth per quarter, 2023, as that year went along, 2024, 2025. If you want, I'll pull it up right now. Let me pull it up. You wanted me to pull it up? I'll pull it up, okay? Okay, so here's to illustrate this point, right? So we go back to 2021, they had insane revenue growth, obviously Rona, shutdowns, everything like that, right? And weaker numbers in 2020, so they were posting great growth. Well, that growth started to decelerate, right? And then the revenue actually went negative for a little bit there, which was kind of scary. So then you go back to early 2023, they had 2% revenue growth. Then they bumped up to 11%, 23%, right? And they had these very weak numbers to comp against there, so their revenue growth looked phenomenal, right? And then they had 22%, 18%, 20%, 16%, 21%, in this latest quarter, 26% revenue growth, right? So we can clearly see there's a trend of Meta's business getting stronger and stronger, and all this spend they've been doing the last 2 years is really starting to show in the numbers in terms of at least revenue growth, right? But they can't let those expenses get too out of line.
The street need to see a return, and how big does that return need to be to justify the spend like this?
Well, we go through the recalibration, and that's what's going on now, and it'll happen tomorrow. And then they need to see it in the December quarter in the form of whatever that revenue growth rate is to be higher, a little bit higher than what people are thinking, and then the expenses to be hopefully a little bit lower than what people were thinking. And so, I mean, there's, this is a long-term thing, a long-term opportunity that they're investing into, but they are being marked every quarter. And so I think that they do need to show some improvement. And I think I mentioned earlier this 18% growth for next year for the top line. The street's at 16 for Meta. I mean, it probably needs to be something like 20%, and them showing that in fact this is driving revenue, just like their AI. It's been the best example of any company at scale using AI to accelerate revenue growth, and they need to continue to show that in the December quarter.
No doubt. Alrighty, next one up here, Fast Money Traders Talk Meta.
For more, let's bring in CNBC's Julia Boorstin. Julia, any guidance on 2026 CapEx?
Boorstin.
Well, CapEx is really a big focus of the call right now. CFO Susan Lee talking about it quite a bit. Both she and CEO Mark Zuckerberg talking about why they are raising their CapEx, saying it's all about investing to drive AI strength and how they need to maintain that position of strength. So they raised the range for 2025 capital expenditures to a range of $70 to $72 billion. That's up from a prior range of $66 to $72 billion. And the company did not share specific guidance for next year's CapEx, but CFO Susan Lee just said moments ago on the call about the importance of expanding infrastructure capacity to enable Meta to seize opportunities, saying they expect CapEx dollar growth to be notably larger next year, saying, quote, "We are focused on preserving maximum long-term flexibility to ensure we can meet our future capacity needs while also being able to respond to how the market develops in the years ahead." Now, Lee also saying they expect to invest aggressively to meet those needs, both by building their own infrastructure and by contracting with third-party cloud providers. Now, that could indicate more cloud deals ahead, and Meta has done some big recent cloud deals, a $10 billion deal with Google in August, $14 billion deal with CoreWeave in September, and a $20 billion deal with Oracle in September as well. So, Melissa, now a new category of stocks that might be impacted by all these AI investments.
Yeah, Julia, keep us posted on the call, which is about 38 minutes in. Julia Boorstin. Once upon a time, higher CapEx was rewarded definitively by the stock market. Have we hit a point, Michael, in your view, where we are reassessing? We need to see ROI, and it is the turn here in terms of CapEx numbers.
Yeah, Melissa, I think that's absolutely the case. I think we're going to see more and more of this over the coming quarters. You know, many of these tech stocks, the tech sector in general, was so attractive for so long because it was viewed as cap light. CapEx light, and now it's CapEx heavy. It's very similar to like an energy and exploration company within the energy space that constantly has to drill new wells in order to realize growth. These guys are all saying we have to invest ever larger amounts of CapEx in order to keep up with AI growth. And I think the value proposition, once you get to these levels, starts to diminish and the return on investment becomes much, much harder.
Yeah, Karen.
Yeah, so this is sort of what I was afraid of, that earlier on, CapEx was seen as good. What does the word notably mean here? I don't know. I'm scared
Sounds
of
like
it.
a lot.
I feel like notably is more than 10%. Mm-hmm. That wouldn't be notable to you, would it?
One thing I got to say about what this does for the economy, because I actually think this is substantial. I mentioned this point, okay? Listen, if Meta, Google, all these companies are not spending all that money buying Nvidia chips and building out massive facilities so they can have all these, deployments of all this technology and whatnot, right? What are they going to spend that money on? I'll tell you what they're going to spend that money on. They're going to spend it on buybacks, right? Buybacks don't really actually do anything for the economy. They don't do anything for the working people, right? But the one good thing I'll say about all this spend on AI is it is something that creates a lot of jobs. Like, you want to talk, these facilities they're building, I don't know if you guys have seen them or looked them up. They're ridiculous, the size of them and the scope, and how many construction workers work on these facilities, right? And how many people make money in all these different ways from these facilities being built. It actually creates an immense amount of jobs. And so that's one thing that I think maybe doesn't get looked at enough, that I'd say, hey man, at least they're actually going to build something with all this stuff, right? They're actually making jobs and creating jobs with all this, right? So, just something to kind of keep in mind there instead of just spending it on buybacks.
I don't know. It seems like more than 10, which is, I think the street was looking for maybe, I don't know, a little over 10%. I think it'll be more than that. I mean, the underlying business is really doing well. They are getting returns. We see growth there. But I don't know that we're getting this kind of spend yet. So it's concerning somewhat. I think we'll hear what they... I feel like they should just rip the Band-Aid off. What do you think the number's going to be?
Right.
Okay, they should tell us what they think the number's going to be for CapEx.
I mean, the backdrop, though, is Meta has always been given sort of the luxury, the benefit of the doubt, because every dollar of CapEx would benefit their own bottom line. But we were talking earlier about, Llama 4. Not so great. So what are the results of all this spending?
Yeah, Meta AI is like a distant behind all those other chatbots that we're seeing right now, and they're trying to fix it. They went out to spend hundreds of millions of dollars. They want to do this research lab. They're kind of saying, don't look here right now, look there. We want to do super intelligence. And, when you talk about what they're getting out of this, obviously, like ad targeting has been really good. I think a lot of the metrics are demonstrating that. At a certain point, you're kind of going to hit a wall, and then they're going to have a lot of competition. If you think about how is OpenAI going to monetize ChatGPT, they're going to get in the digital ad game. Like, that's going to be a big way of how they do it. So you're going to see pressure around the whole space. But the one thing I'd mention about this build out of these data centers, they're just now starting to hit the debt markets, right? And you think about this deal that Meta just did to build this data center in Louisiana. Well, they're basically taking a 20% stake. There's going to, Blue Owl is lending them $27 billion. It's going to go into a special purpose vehicle. And, it's all this stuff, man. And some of that debt is literally going to be issued at 1% above. Like, it's going to be, Mike can get in here, it's going to be like junk. And then it's going to find its way into all these ETFs and all these big, debt portfolios. So all of this stuff is becoming very financialized. And we've been talking about this for a couple of years. These companies have been funding this build out through their cash flow and through their large cash balances. And now it's hitting a wall because 30% of their revenue, it's got to stop at some point, right? So this is, to me, the spot. And Oracle is in the worst spot of all of them. I think their debt to equity is at like 500% or something like that. They're going to be the ones holding the bag, then the neo clouds, and then these guys, because they've done this off balance sheet stuff, it's probably going to end up pretty good for them.
Yeah, this is where you get the parallels to the late 90s and early 2000s. You had a tremendous amount of debt issuance going to build out basically the fiber optic network that became Fios and everything else. Now, in fairness, you had companies doing this that really had no business levering up their balance sheet and ultimately went bankrupt. And I don't think we're worried about that with respect to the Mag 7 and some of these larger tech companies. But the story still rhymes. And you are starting to see a lot of this debt. You're also starting to see guarantees now from some of these players to smaller infrastructure companies, construction companies, et cetera. And that's a new thing that we're seeing in the debt markets. Guarantees by Google for someone to build out a data center and issuing debt in order to do that. That's something that's never been done. That always makes me a little bit nervous.
So they took a $16 billion charge. So if they had not taken that, EPS would have been probably 10% better than expected. It would have been 7.25. The street was at about 665. They beat revenues by about, I think, 4% better than the street was looking for. Margins are now north of 40%. I get it that people are concerned about the spend. Where are they going from 69 to 71 billion? I mean, to me, that's a bit of a rounding error. But I understand this level that we're looking at now is where we traded down to at the end of July and held. So I actually think you buy Facebook here.
Yeah, so it's funny. He always calls it Facebook. Start calling it Meta. Come on, man. The name's been changed for years now at this point in time. I mean, the moral of the story is in regards to Meta, like, even despite the very out of control spend, right? Zuckerberg's got to be up to big stuff here. People question him time and time again, but he always comes through in the end. Does he not? Yes, he always comes through in the end, right? With actual big numbers, like not like he promises something and never comes. No, he says we're going to do this, going to do that, and it ends up becoming the next big thing. So Meta remains a buy, okay? Pinned comment down there today if you're looking to apply, join our private stock group, private wealth group, get access to thousandxstocks.com. If you join us on a lifetime membership, we'll send you this beauty in there. Ooh, love that card. And then, no matter what, when you join us in there, we'll send you your 1000X Steel membership card. It's up a 2025 edition. This is 2024 edition. And then we'll send you your private stock group card as well. This one's beautiful. Put those in your wallet. Bust them out. Show them off, okay? It has been quite a 3-year ride. And for anybody that's been with me on this 3-year ride, it's been a lot of fun, right? 3 years ago, public count just over $1 million. And to see that at nearly 4.2 million right now is pretty shocking. I mean, honestly, if you asked me 3 years ago where the public count would be at, I wouldn't have said 4 million. I probably would have said 2. I maybe would have said 3, but certainly not 4. It's been quite unbelievable, right? But here we go. We might have some weakness. Okay, Cheesecake Factory down over 7 percentage points here today. I'm now up $31,000 on that stock. That does not include dividends, but that was a $12,000 hit here today. Adobe, a new stock of mine, down 6+% here today, right? That stock has started out at about a 4% down position. I had $1.2 million riding into Meta earnings in the public account, and look at this, Meta down 7 percentage points. So the indestructible Jeremy is now looking a little like the armor, right? I used fancy AI to create this image. The armor is kind of falling off here, and we're like, oh, what's going on here? Like, is this ride about over, right? Meanwhile, we have the other side of things. Google, a somewhat newer position for me, has been doing so well. Up $52,000 on the stock. And guess what? It's up more after hours here today. Fubo got great news here today. This is a speculative stock I own, made about $28,000 on so far in the public count. Got great news in regards to that stock here today. Palantir's on a generational run. Like, you want to see a generational run, look at Palantir stock the past 3 years. This is a truly generational run. I mean, 3 years ago, you get this stock at $6, $7, $8, right? And today, it almost touched $200 a share. Somebody in the comments keeps saying that Nvidia and Palantir both have to go over 200, and then we're going to have the stock market crash. So we'll see what happens with that, okay? In this beast video here today, 8 subjects to go through. Jay Powell. We got to talk about Jerome Powell quickly at the front here, what this means for the market and where we're headed from here. The 2 big things did happen that not a lot of people are talking about that I got to explain, okay? Then we're getting to Cheesecake. What's going on there, where that stock's headed? Adobe. What's going on there, where is that stock headed? Meta. What's going on there, where is that stock headed? Google. What's going on there, where is that stock headed? Fubo, what's going on there? Where is that stock headed? Then we're getting to 2 stocks I bought here today. I put a little over $7,000 in each of them. So we can call it around a $14,000, $15,000 move. Talk about what stocks those are, why I did it. And then we'll get into Palantirs in this video. I hope you guys enjoy this beast, man. It is so busy for me every single day right now. The only thing I need from you guys is just smash the like button. That's if you could just do that for me. I mean, the amount of earnings coming out, trying to listen to these conference calls, grade these income statements, right? Record the private stock group video today. It's just ridiculous. So I appreciate you. All I need from you is just smash that like button, make that like button glow. That's all I need from you. If you want to be subscribed to the channel because you want to see more of my videos in the future, make sure you're subscribed here to the channel. We are now over 900,000 subscribers. Incredible. incredible, man. Absolutely incredible. And yeah, I think we just hit that yesterday, I want to say. So thank you every single person that subscribed here to the channel, okay? Additionally, pinned comment down there here today will be if you're looking to apply to join my private stock group, private wealth group. Demand is ridiculous. Out of control, ridiculous to join us in there. We're now up to 2,717 members. We had another 6 members join before I even woke up today. It's been out of control. Just yesterday, I had to count it up. I'm like, how many people applied to join the private group yesterday? 126 people applied to join the private stock group yesterday. To put that in like context, 15 to 25 usually apply on a normal day. 126. It's so ridiculous. My guys are so busy right now that literally I'm thinking about potentially closing the private stock group to new members in either November and December. It's out of control right now. When you join us in there, we will send you your Steel membership cards. That's access to all my course curriculums, a Discord chat, exclusive weekly videos like the one I recorded today, access to see all the moves I'm making, my $4 million plus Fidelity account. That will be pinned comment down there to join us in there before I might close it down to new members because this is ridiculous. Alrighty, guys, let's get into JPOW here off the top. Listen, they lowered the Fed funds rate. No surprise, but few very important things did happen, okay, that matters significantly in market. In addition to the rate move, the Fed announced that it would be ending the reduction of its asset purchases, a process known as quantitative tightening, on December 1st. Now that sounds like a little confusing. That sounds like, is this going to be anti-market or how does this work, right? Remember, quantitative tightening is a monetary policy where a central bank reduces the amount of money in the economy primarily by letting go of holdings of government bonds, securities. So it's basically shrinking of the balance sheet, okay, is the best way I can put it. And that's usually bearish for the stock market. You could look at it as also bearish for the economy. If the Federal Reserve is actually shrinking their balance sheet at a particular time, you could say, ooh, that might lead to problems down the road. Now, when they start quantitative tightening, it's usually because the economy is like too hot. It's too good out there. So it's usually like things are too good, so we need to start quantitative tightening. We need to bring down the balance sheet, right? Which then ends up actually hurting potentially the economy and those sorts of things, right? This is ending now at this point in time, right? Which then sets you up for what's called quantitative easing. Now, there's no promises of quantitative easing coming, but when you end quantitative tightening, which is ending in December, that sets you up to then, if let's say the economy or something goes off the rails, a lot more job losses, let's say in 2026, right? Fed can lower rates even faster and then start quantitative easing, and they could do things like actually start to purchase assets again for the balance sheet and actually increase the balance sheet, right? If you look from the peak of 2022, where the Fed balance sheet peaked right here, about $9 trillion, the Fed's brought that down by over $2.5 trillion, right, from that 2022 peak, which is crazy. And you know, the fact that the market hasn't crashed is pretty shocking. A lot of people expected, if you would have told people, honestly, 3 years ago, the Federal Reserve is going to bring down that Fed balance sheet $2.5 trillion, what do you think is going to happen in the market? I think almost every Wall Streeter, every economist would have said the market's going to crash in the next few years. They can't bring that down $2.5 trillion. We're not going to be able to withstand that. Guess what? They did it. And stock market's actually, all-time highs it hit here today? Like, it's unbelievable, right? Now, another very impactful thing that happened is, did you see what happened with the 10-year today? The 10-year Treasury spiked higher, which is pretty shocking. Like, this is a huge move for the 10-year, like a huge spike up there. It was in the 3s. And so keep this in mind. If the 10-year goes higher, mortgage rates likely go higher. 10-year matters significantly to mortgage rates, in which means at the end of the day, like, that means the real estate market could be even more dead than it's already at, right? Now, keep in mind, the Fed could do some things in 2026 to potentially bring down the mortgage rates overall, even if they can't really bring down that 10-year. The Fed can influence mortgage rates by buying specific assets, such as mortgage-backed securities, to lower their yields and thus mortgage rates, right? They did that back in 2020, 2021. So keep in mind, the Fed has some other cards up their sleeve to bring those mortgage rates down. We know T-Man wants mortgage rates down, right? So we'll see what happens with that. I'm going to sign my name on a mortgage next year at some point in time. I would love them to bring mortgage rates down, right? That's just, I can't complain about that. But we'll see. We'll see what happens with all that, okay? Cake, next up here. What's going on with Cake? All those sorts of things, right? Listen, Cheesecake's a huge buy right now. The stock's trading at a forward P of 14. 14, which basically is telling you the company's got no growth. Like, it's like, just a profit machine, ATM, but it's kind of a dead company, right? They're not even trading at a market multiple. They're trading significantly under a market multiple right now, right? But check this out. I posted this inside the private stock group. You got to dig deeper into the transcripts of these conference calls to get the data, because they actually didn't post this data, okay? You got to listen to a conference call or look at the transcript, which I looked at 1000xstocks.com, okay? Flower Child revenue grew 31% in the quarter. Remember, that's one of the key businesses I'm talking about is like a growth engine for the company for the next 5-10 years. 31% revenue growth. North Italia, the other one I keep talking about, if you've listened to me talk about Cheesecake for the last few years, right? What's the other brand I talk about? North Italia. That grew revenue 16% in the quarter. So those two businesses are growing substantially, and that's not going to stop anytime soon. Like the next 5 to 10 years, you're going to see significant revenue growth from those two brands. And remember, the base is getting bigger for those two brands. The raw revenue numbers is getting bigger, which is going to ultimately help the revenue of the overall company actually accelerate substantially in 26, 27, 28, and beyond. So that's something important to keep in mind there, right? Private Stock Group member asked about comps for the quarter, because comps, for Cheesecake, they weren't horrible, but they didn't look good for the different brands at Cheesecake, right? And they're asking, do I think there's something wrong with Cheesecake, or do I think it's more industry-wide? And I said, I think it's, weakness in the industry overall in the restaurant category, right? I think the whole category looks rough at the moment. I said, I'm going to keep a close eye on Chipotle earnings to see their comp store sales. Well, guess who came out with earnings after the bell here today? Is it Chipotle? And guess what happened? Chipotle reported a miss on their same-store sales, but it gets even worse than that. Look at this. Chipotle was expecting the overall year same-store sales to be flat, which is already a disaster for Chipotle, right? They should be always growing their same-store sales. Now they're talking about low single-digit decline. That means they're going to be doing less business in each one of their restaurants than they did in the previous year. Like, we've never really seen this outside of what? Maybe when they had the whole health scare situation years ago, right? That's insane. Absolutely insane for Chipotle to be in that sort of situation, right? And if you've been following my content for a while, what's the one stock I used to hate on all the time back in 2024? I was so bearish on the stock, and anytime I got a chance, I took jabs at it, and I told you guys it was going to get ugly for this company. It was Chipotle. And that was back when this was like a $60 stock, right? And I would talk about they've been making so many missteps in the company. I talked about the CEO's leaving the company. That's not a good sign. The fact that he's leaving to go to Starbucks, another messy company, like that means this ship is going down, right? This is a Titanic. And when I say this Titanic, this doesn't mean that they're going bankrupt. That doesn't mean they're going out of business. It's just the stock was destined to have a massive downtrend. And that's what's going on here now. And now basically everybody that's bought Chipotle in the last several years is now down substantially, and you could get tax loss selling into the end of the year. It's an ugly situation in regards to Chipotle, and I called that out years ago, right? Now, in regards to Cake, to bring it back to Cake, why am I so excited about this stock? The stock's a huge moneymaker for me over the next few years. Check this out. I ran them at only 7% revenue growth on average, 2026 to 2029. Very doable number given the growth of Flower Child, given the growth of North Italia. That's no problem at all. I did them net income growth at 9%. Those two concepts should make them much more profitable, right? And a lot of that should head down the bottom line. We're seeing continuation in that EPS growing very nicely for the company year over year, right? Net income as well, right? Income from operations. So I think 9% net income growth on average per year, 2026, 2029, is not a crazy number at all. This still has them at net income margins in the 5% range, right? If you're growing high single digit revenue, high single digit, we can call it net income, right? For a company that has this much growth over the coming years in several concepts that are successful, I think a 25 to 30p is fair for a company like this, right? With those sorts of growth rates. We're talking about a CAGR that's mid-20s, maybe all the way up to 30% range over the next few years, right? We're talking about a stock that goes to 125 to 150 come 2029. I'm going to buy it. Like, it's just a steal deal, right? Steal deal overall for this company. But even look at my bear case. My bear case has revenue growth of only 5%. That'd be horrible. Net income growth of only 5% per year, 2026, 29. Disaster, right? Remember, they should grow revenue 2 to 3% a year just based upon inflation, right? You always got 2 to 3% inflation pretty much out there, so your pricing on your menu is going to go up 2 to 3% pretty much every year to offset that cost, right? So 5% with all the growth in North Italia and Flower Child and their other concepts as well, And remember, they're still actually growing Cheesecake Factory locations as well. Whoa, this would be bad. This is very bearish, okay? 5%, 14 to 19 PE, right? Significantly under a market multiple. And I still get a CAGR of 5 to 13%. I got to take that. I got to take that every single time. So Cheesecake's a buy. It's a buy. And guess what it is? It's a buy. Okay. Next up here, Adobe. What's going on here? Where's the stock headed? Well, they got a multitude of bad news. Adobe launches AI assistants for Express and Photoshop. Adobe now lets you generate soundtracks in Speech and Firefly. Adobe to release AI-powered video editing system, Project Frame Forward. Wait a minute. Okay, that wasn't the bad news. Okay, here's the bad news. Adobe stock is down despite analyst praise. Okay, wait a minute. Adobe CEO says the stock is undervalued. Okay, wait, that wasn't the bad news. Okay, here's the bad news. Adobe announces YouTube Shorts creation tool in Premiere. YouTube Shorts will integrate Adobe's Premiere video editing tools. Wait a minute. Okay, that's not the bad news. Okay, here's the bad news. Adobe might have just solved one of generative AI's biggest legal risks. Shoot. Oh, there's no bad news in regards to Adobe. It's the same fear-mongering stuff that we hear quarter after quarter after quarter. They're going through this same exact thing that guess who just went through this whole cycle? Google McDougal. Google McDougal just went through his whole cycle. And now everybody doesn't care about all the fear anymore, right? Because Google just kept coming in and putting up their numbers and putting up their numbers. And so all Adobe has to do is just come in, put up your numbers, quarter in and quarter out. And guess what? People are going to love your stock. They're going to finally get off this like bearishness that they've been stuck on here in regards to Adobe, right? So Adobe, here are my numbers for Adobe. These are not crazy numbers. This is my bull case. 10% revenue growth, 12% net income growth, 25 to 30p. It's kind of a SaaS play, recurring revenue business model, like beautiful business model, right? Asset light. Get a 20+% CAGR in that sort of scenario. My base case for Adobe has an 8% revenue growth, 10% net income growth, not crazy numbers, 23 to 28p, 15 to 21 CAGR on this stock. Like, you know what, like it's a buy. You know what I mean? Like it's not the most complicated thing in the world. And remember, with my numbers, I haven't even factored in if they actually are a huge beneficiary of AI. My numbers are factored in that if anything, AI is a little disruptive to certain practices or business models, so it hurts growth rates a little bit. That's what my numbers are based on. And like, we don't know, like with how much Adobe's innovating here, like they don't just have all that team there for nothing. Like maybe AI is actually a beneficiary. Maybe they start growing 12% revenues, 15% revenues, 20% revenues. We don't even have that in the numbers. Do you know what the CAGR will be if that happens? We're talking 30 and 40% CAGRs if that happens. So that's not what I have, but even with my sleepy, boring numbers, it still should be a huge moneymaker over the next few years. Okay. Oh boy, Adobe. Okay. Meta. Okay. Big dog. Okay. Here we go. Meta, the big dog. Okay. Alrighty. So first off, Meta, great revenue growth from this company. Look at this. Look at this. Revenue growth went from $40.5 billion to $51.2 billion, right? Cost of revenues increased for the company like you would expect to $9.2 billion from $7.3 billion. R&D was up a lot. It's a $4 billion move. I mean, run that on a percentage basis and you should be, somewhere in the, that would be what, a 35% growth number, somewhere around there roughly. As far as R&D, it's a huge increase in R&D, right? Marketing and sales basically flat year over year. That's unreal. The fact that this company grew their revenue by close to $11 billion, what, $10.7 billion or so, and marketing sales was flat, legendary. Like that was something you for previous business models, you never would have thought that was possible. G&A was a problem for the company. G&A basically doubled year over year, so that was a big increase there, right? So total costs and expenses went to $30.7 billion from $23.2. So expenses were a little high, right? And so if there's one thing you want to poke at for Meta, it's Zuckerberg might be going a little too aggressive with the expenses, right? We want to see expenses growing less fast than revenues, right? So income from operations still increased nicely to $20.5 billion from $17.3. Income before income taxes went to $21.6 billion from $17.8 billion. Now, they had this one-off here, this provision for income taxes. This was a one-off, massive, almost $19 billion hit, which killed their GAAP EPS. But if you look at their non-GAAP and you take out that one-off, like, it was phenomenal. So that's why I graded them a B- overall for this income statement here. Now, look at this. This is very important for all the longs that are in this stock for the next several years. We expect a significant reduction in our U.S. federal cash tax payment for the remainder of 2025 and future years due to the implementation of the One Big Beautiful Bill Act. So, tax is going to get a lot more favorable for Meta over the next few years, okay? However, the implementation also led to the recognition of a valuation allowance against our U.S. federal deferred tax assets, reflecting the impact of the U.S. corporate alternative minimum tax. As a result, the third quarter 2025 provision for income taxes includes a one-time non-cash income tax charge. Non-cash income tax charge. It's very key, okay? Of about $16 billion. Excluding this one-time tax charge, our third quarter numbers effective tax rate would have decreased 73 percentage points. Net income would have increased by $15.9 billion to $18.6 billion, and diluted EPS would have been $7.25 instead of the diluted EPS of $1.05. Okay, so the moral of the story is here: tax is going to be a huge help for Meta from now on. But they had to take this one very large non-cash income tax charge of about $16 billion. Okay, that's very important. Very important. Now, this was kind of shocking to me. Daily active people. So this is, people using all the different apps. They have Facebook, they have WhatsApp, they have Threads, they have Instagram, all these different products. Messenger. That actually increased 8%. Like, every time you think, like, there's no way Meta can grow the amount of people using the service. They do it. I don't know how they do it, but they do it, man. And sooner or later, I think all 8 billion people on the planet are going to be signed up for at least one of Meta's apps and use it on a daily basis. It is shocking. Ad impressions increased 14% year over year. Average price per ad went up 10% year over year. So basically, they're showing more ads. People are likely using the products more often, so they're getting to show more ads. And then what they're being able to charge advertisers is a much increased amount as well, which, keep in mind, that's very important. Meta's spending a lot right now to basically get their get people to spend more time on their platforms, right? And show them content and stuff that'll keep them on the platform longer. That's how AI is helping them make more money. The second part is, right, so they can show them more ads. The second part is, Meta wants to essentially be able to charge the advertisers more and more money. How can you charge advertisers more and more money over time? Guess how? By making them more money. So they're using AI to hopefully show the right people these ads so companies can make more money off of those ads and get a better ROI on those ads, right? If they get a better ROI, those companies have more advertising budget to then spend with Meta and funnel it right back in. So if you're wondering, how is Meta actually making money right now from AI and can continue to for the next year or two? Let's not talk about what they could be doing with AI and how they could make money from that 3, 5, 10 years from now. What about right now and what about next year? Keep people on the platform longer, because you're showing them stuff they actually want to see, right? And keep them engaged in the platform. And 2, have your companies make more money so they can spend that right back with you, right? And you're going to be able to charge even more for ads. Very, very key, okay? Now, revenue went to $51.24 billion. That's a 26% increase, which is shocking, man, shocking. Now, this is the one issue I would point at Meta. Total costs and expenses was up 32% year over year. So that's the one thing I'm like, okay, Zuck, we're going a little heavy on the expenses here. Let's chill, right? I really want to see Meta be in a situation where they're growing revenues at a faster clip than expenses, right? I do not like to see those expenses rising faster than revenue. I'd say, if costs and expenses were up 20% year over year, or even 25%, I would say, okay, that's fine, right? Because the revenue number is a lot bigger than the expense number. So keep in mind, even if the percentages were the same, like let's say revenue was up 26% and expenses were up 26%, the raw number would be way dramatically bigger for revenue, because 26% of 51 billion is a lot more than 26% of 30 billion, right? It's just math. So that's the one issue. I don't like that the percentage is so much higher here. Okay, so yeah, Zuck, we got to get that fixed over this next year or two. Now, additionally, you think about that revenue growth rate of 26%. They're growing faster than anybody in the space when it comes to Mag 7, except one company, and that's, guess who? These guys right here, Nvidia, right? So Meta's the king. Can't call him the king. Well, Nvidia is still the king of growth when it comes to Mag 7. They're the number 2 when it comes to Mag 7. So if you want exposure to Mag 7 and you want big growth, you know who to go to if you don't want to go to Nvidia. And I understand there's a lot of fear about Nvidia because like numbers might peak in the next year or two or things like that, right? With Meta, if anything, they're showing accelerating growth and they show consistency in growth, right? And so if you want growth and you want Mag 7, there's one stock you go to, and that is Meta. Now, when it comes to Meta, here are my numbers, my bull case, base case, and bear case for this stock. This stock is a steal deal buy right now, okay? On my bull case, I haven't grown revenues 20%. Keep in mind, the company just grew revenue 26%. So even in my bull case, I have them growing revenue significantly under what they've been putting up. Keep that in mind, okay? I like to do my numbers a little more conservative. This is my bull case. I'm doing 22% net income growth on average per year, 2026 to 2029. Getting a 39% net income margins, 35 to 45 P would be very fair for a company growing 20%. Top line, 22% bottom line, right? That would put the stock somewhere between about a $2,200 stock and about a $2,800 stock come 2029. My base case, this is what I expect for Meta, okay? 15% revenue growth. They just grew revenue 26%. I have them growing 1,100 basis points lower in my base case than what they just grew in that quarter. Talk about being conservative. 15% revenue growth per year, 18% net income growth per year, 2026 to 2029, 29 to 34 PE for the stock, right? And look what we get. We get a CAGR that's well into the 20s for this company with those, in my opinion, very conservative numbers. How are you not buying Meta right now? You got it. Like, do you like money? You like free money? You like free money, own Meta stock. You don't like free money, don't own it, right? The stock, in my opinion, is going to $1,000 plus next year in 2026, right? My bear case for Meta. This would be bad. 10% revenue growth? Disaster. All this money spent on AI and they only get 10% revenue growth per year? Disaster. Net income growth, 10%. All this efficiency they should be getting from AI over the next 4 years and they only average 10% net income growth? Disaster. Okay, got a company growing 10% top line, 10% bottom line, 23 to 28 PE is what you're going to pay for that stock. Guess what? I still get a 6% to 12% CAGR on the stock. And that's under a disaster scenario. When I can run my numbers and get performance that's likely going to be better than the S&P 500 in a disaster, give me every share you got. Listen, say thank you. Say thank you to the algorithms, the algos, okay? Because as soon as those numbers came out, the stock went down 7%. Like literally within minutes of the numbers coming out, it was already down 7%. This was not humans deciding to sell Meta stock off. It was instant. As soon as that EPS hit from the one-time tax hit there, non-cash tax hit, right? As soon as that happened, the stock was down 7%. It was like, boom, right away, right? So say thank you to the algos for this move down if you're somebody that's been looking to build a position in Meta, because that's incredible, man. Like, you just got gifted. That's the best way I can put it, okay? Next up here, Google, McDougal. Then we'll get into Fubo. Then we'll get into 2 stocks I bought, $7,000 a piece. I put in those today. Then we'll get into Palantirs. Google McDougal, B plus income statement here. Revenues went to $102 billion from $88 billion. Very nice revenue growth from Google. Like a lot of people thought Google wouldn't even be able to grow double digits. Now they're growing at mid double digits revenue. Very impressive, Google McDougal. Cost of revenues went to $41.3 billion from $36.4 billion. R&D also a little bit of an issue for Google. So these companies are spending, their spending's getting close to like a little out of hand, right? R&D, $15 billion from $12.4 billion. G&A, also an issue for Google McDougal, $7.3 billion from $3.5 billion. Total costs and expenses went up to $71 billion from $59.7 billion. Income from operations went to $31.2 billion from $28.5 billion. If we look at income before income taxes, because they had a big other income here, it's kind of more of a one-off situation. $43 billion versus $31 billion. Net income almost $35 billion versus $26 billion same quarter last year. But once again, that big kind of one-off really helped there. The income from operations increase wasn't nearly as impressive as you would have expected, right? Because basically 10%, if their income from operations was up 10%, that would be $2.8 billion. And that's roughly what they were up there, right? So we can call it income from operations look like it didn't even grow as fast as revenues grow. So that's why I graded them a B plus and not into the A grades, right? So that's Google McDougal here. Now, the important thing to understand about Google is they're actually accelerating growth quarter after quarter after quarter right now, right? Look at this. They went from 11% revenue growth to 12% to 13%. In this latest quarter, 16% revenue growth. Bravo to Google McDougal on continuing to accelerate growth. Like I said, the whole story about, Google's dead, they're done, AI disruption, that was the talk. I mean, it's that talk started in 2023 and was really ferocious for Google in 2024 and into the beginning of this year. And at the end of the day, look at the numbers. The numbers are phenomenal. And keep in mind, this quarter, they just put up that 16% growth. That was coming off of last year's quarter. They grew revenue 15%. Very impressive, Google McDougal. They're doing a dang good job here, right? Now, as far as what are my bull case, base case, bear case for Google stock, well, my bull case has them, guess what? Growing revenue at less than what they just grew revenue at. 16% is what they just grew revenue at. I am at 14% per year over the next 4 years, right? I am at a 16% net income growth, so getting a little leverage there, right? 33% net income margins come 2029. 27 to 32 PE would be very fair for a company growing. We can call it mid-teens revenue, mid-teens net income. 27 to 32 is very fair. That gives me about a 16 to 21% CAGR here for Google. Now, my base case has 12% revenues on average. This is what I actually expect to happen. 14% net income growth on average. 24 to 29 PE. 10% to 16% CAGR. Here's the thing with Google, okay? It's a good buy right now. But you're going to make way more money in Meta likely over the next 4 years. It's as simple as that. Google, good buy, more money's to be made in Meta. These companies are very similar in terms of how people view them. So at the end of the day, do you want to make more money or less money? You want to make more money over the next 4 years? Buy Meta. You want to make less money but still good money? Buy Google. It's up to you, right? Bear case for Meta here, or for Google here, 7% revenue growth on average, 8% net income growth on average, 20 to 25 PE, and basically we get a flat return to maybe slight growth. So the bottom line is, if things are bullish, I'm going to make more money in Meta. If things happen like I expect them to happen, I'm going to make more money in Meta than Google. And bear case, same exact thing. And that's why I have $1 million plus in Meta stock, and I only have $100-something thousand in Google stock. Because at the end of the day, Meta's just going to be a way bigger moneymaker 2026 to 2029. And I don't even think there's really a debate about that, right? And remember, we're talking about Meta just grew revenues 26%. Google grew revenue 16%. 16% is very impressive. How many companies are growing revenue 16%? Especially that are large companies. Very few. It shouldn't be shunned. It should be appreciated. But they're getting whooped. Absolutely obliterated by Meta. Meta 26, we're talking 1,000 basis points of revenue growth on Meta versus Google. That's, incredible. Absolutely incredible. Next up here, Fubo. What's going on with Fubo? Where's that stock headed? Then we'll talk about some stocks I bought here today and then Palantir, okay? So the best news of the best news you could have gotten in regards to Fubo happened today. Disney closes deal merging Hulu Live TV with Fubo. This was a long anticipated deal. Took a while for it to finally get through the government and everything and all the loops there. Disney and Fubo announced closing of their deal merging Hulu Live TV operations with Fubo, with Disney owning 70% stake in the new company. The newly combined Fubo and Hulu plus Live TV business creates the second largest virtual pay TV provider in the United States, with nearly 6 million subscribers in North America. That trails only Google's YouTube TV, which has an estimated more than 10 million paying subs, which is currently involved with carriage renewal fight with Disney, which is interesting. And man, you want to talk about making YouTube TV irrelevant, especially to sports fans? Take away ESPN. Ooh, boy. You want to see all of a sudden people flooding out of YouTube TV? Because remember, a huge component of the reason people are willing to pay for YouTube TV, Fubo, anything else like Hulu plus live TV is because of sports. Sports is huge, okay? Now, obviously they should figure out a deal there. Like, I don't think, ESPN wants to lose access to YouTube TV, but I'm just saying, like, they got a lot to stand on there. Disney and Fubo received clearance from the Justice Department's Antitrust Division to complete the transaction, according to two sources familiar with the matter. As part of the deal, Fubo Advertising Sales Group will move over to Disney's advertising sales organization. That could be a huge cost savings and could also mean a lot better ads for Fubo moving forward. The companies emphasize that Fubo and Hulu plus live TV will continue to be available to consumers as separate and distinct services, each offering consumers multiple plan options from skinny to robust at compelling price points. In addition, Hulu plus live TV will continue to be streamed in the Hulu app and offered as part of the bundle with Hulu, Disney Plus, and ESPN Unlimited. Okay, very intriguing. The new company offers consumers more than 55,000 live sporting events and entertainment-focused programming offerings from Fubo and Hulu Plus Live TV. Remember, Fubo, the big reason you sign up for Fubo is sports, right? Like, I have Fubo personally. I've had Fubo for years, and it's a huge thing for sports, especially me because I like college football a lot, and Fubo allows you to watch 4 games all at once, choose whatever games you want. They've got just about everything you could possibly imagine in Fubo when it comes to college football and things like that. So sports fans, it's big with Fubo, right? As a deal closing, Disney holds approximately 70% interest in the newly combined company, with existing Fubo shareholders holding an approximate 30% interest. That's people like me, and if anybody else owns Fubo out there, you. The combined company will have access to a $145 million term loan that Disney has committed to provide Fubo in 2026 as part of the transaction. According to the companies, the merged Hulu plus Live TV and Fubo business expects to realize cost, revenue, and operational synergies through content cost savings achieved by the more flexible programming packages, advertising optimization, and sales and marketing opportunities. So the moral of the story is cost basis, if anything, should come down significantly as a percent, right? Which means a lot more profitability. And Disney's very incentivized to have this service be, let's call it, very successful. And Disney owns a lot of assets, including they own ESPN, right? And guess what? ESPN now owns part of, or did they buy out NFL Network? I'm trying to remember. Did they buy NFL Network, or did they buy part of NFL Network? And then if I recall, also ESPN now owns part of the NFL. They're now tied in with everybody. Like the tie-ins are like everything, right? Like Disney's played a masterful game of trying to control sports as much as possible, right? In terms of like controlling the content around that, right? And also you got to remember Disney's kind of at war with Google, right? And the reason being is, like, think about advertisers, right? They're both advertising giants, so they got to kind of fight over that. But also remember, like, if YouTube TV and Google's too successful, Google could buy a lot of exclusive rights over time. Like, for instance, a good example of this is the purchase of Sunday Ticket, right? And they purchased that out. They added that inside, exclusive deal there with their YouTube TV product. So keep in mind, Google's got a lot of money to spend. If they wanted to buy out certain NFL rights and only have those games on YouTube TV, they could. Right? Same thing with basketball rights, baseball, Formula One, all these different things. So Disney has to fight off all these big dog tech companies that are competing. Amazon obviously has Thursday Night Football now. So it's a big battle there, right? And Disney's got to fight hard here. And so Disney's very incentivized to have this entity be as successful as possible. They're going to get more control there, right? And they don't want YouTube TV to be too successful at the end of the day, because that gives Google even more power to buy out more content rights over time, have exclusive programming on YouTube or through YouTube TV, all that good stuff, right? No, people were mad of the stock basically today, because the stock didn't make a big move. And like, come on, man. Like, we got the big announcement. First off, okay, this had been rumored on X for days now at this point in time. So it wasn't like this was some, like, no one saw this coming, and everybody pretty much knew the deal was going to go through. Like, it was just a matter of time, right? And there was already rumors circulating all over X that this deal was going to go through this week, right? And so people bought call options thinking like Fubo stock was going to go to the moon and it was going to go $5, $6, $7, right? And you know, it's $3.69 here today. And so, you know, people that were speculating on calls, listen, I saw the rumors out there as well this week that the deal was likely going to go through. Did you see me buy one call option contract on Fubo this week? Because I'm like, oh, shoot, the rumors are out there. The deal's going to go through this week. No, it's ridiculous. Like, I don't need to play gambling games, man. We're going to focus on the long here. We're going to focus on the big opportunity that Fubo has ahead. If Fubo's successful, it should be a $10, $20, $30, $40, $50 stock long term, right? And so I don't need to risk a bunch of my capital playing, oh, the deal might go through this week and the stock's going to spike 30%. I'm not going to play that game, man. I'm not going to play that game. It's just too much stress, too much distraction. It kills your wealth if it doesn't play out that way, right? For something that, like, everybody knew the deal was going to go through. The big move happened when this whole announcement came out, which was, what, over a year ago now at this point in time? Fubo at that time was $1 something. If you were in the know at that time and, you know, you made game-changing money, obviously, in the stock, right? But this, like, everybody knew that it was just a matter of time. And then the rumor had already, like, everybody that is aware of Fubo stock already heard that rumor on X days ago. So, you know, to think, oh, it's going to come out now and, like, the stock's going to go to $5, like, you know, come on, man. Alrighty, next up here, two stocks I bought $7,000 plus of each. Let's get into that. First one, PayPal. Bought about $7,300 worth of PayPal here today, $69 and some change I paid for those PayPal shares. I spoke about PayPal very in depth on my reaction channel. My reaction channel is called Jeremy Lefebvre Makes Money. I'm sure a lot of you guys follow me over there as well. And very, very excited about PayPal. Like, I'm the most excited about PayPal I've been since probably I invested in the company. I'll be honest with you guys, my entire investment time I've been investing in this company, this is the most excited I've been. Seeing the latest revenue growth numbers, seeing the partnerships they're starting to have all over the place, including the newest OpenAI deal, man, this is the most excited I have been for PayPal my entire time I've been investing in this stock. And it wasn't that long ago, even a few months ago, that I was kind of like, dang, you know, even like 6 months ago, the revenue growth went down to 1%. I'm like, I might have just made a big mistake with PayPal. Like, it might not be the one, right? I might end up never making big money on this. I feel very differently today. I feel very confident PayPal's going to run to 150. And could the stock go back to 300 plus like it used to be years ago? If they could accelerate that revenue growth to double digits and keep it there for a few years, we'll see the stock back at $300. But they got to be able to pull that off. If they don't pull that off, you know, maybe we can talk about a stock that maybe goes to 150. So I love PayPal. Once again, if you want to hear more in depth, I talked about SoFi, PayPal, a lot of those stocks on the reaction channel last night. Okay, I think that was like a 56-minute video or something insane. Okay, next stock I bought today is, guess what? Cheesecake Factory. Over a $7,100 move here in regards to cake. Paid $50.05. Cake, I love it, man. I love it. You know, I already spoke about cake in this video, so I don't want to go back into it. But the bottom line is I'm getting a dividend stock that pays me dividends every 3 months, trading at a value price that has insane growth engines underneath the company, like Flower Child growing revenues at 30+% clip, North Italia growing revenues at 16% clip, and I got the cash cow that is the Cheesecake Factory brand. Oh, and by the way, I got a bunch of restaurant concepts they're testing around the United States right now to see if those are the next big ones. Like, it's beautiful, man. Like, it's one of the best, in my opinion. If you're a long-term investor, it's one of the best stocks you can find in the market, right? I understand, like, everybody doesn't care about restaurants right now. The industry's down. Like, oh, AI, who's a chip company? Avago, AMD, Nvidia. I understand everybody's, you know, Palantir, the momentum. At the end of the day, we'll look back at the returns of the stock over the next 4 or 5 years, and I think we'll be pretty shocked that it's going to actually outperform significantly many of these high-flying tech stocks. Like, you'll watch Cheesecake from 2026 to 2029 significantly, in my opinion, outperform many of these super hyped, talked about tech stocks right now that everybody can't get enough of. And just watch. Little sleepy Cheesecake will outperform them all. And Guess what? Except AMD. I don't know. AMD is the one I'm like, I don't know if they're going to outperform AMD, but probably just about the rest of them, right? And this isn't the first time this happened. Look at Texas Roadhouse stock. Texas Roadhouse stock went on an incredible 10-year run and actually outperformed not only the NASDAQ, but significantly outperformed many of the best tech companies in the world. Sleepy old Texas Roadhouse. Isn't that incredible, right? Sometimes these boring stocks, look at Costco's performance over the past 10, 15 years. Sometimes these sleepy stocks could be the best performers you ever imagined. And I'm sorry, but you got Concepts growing 30+% revenues, 16% revenues. I don't think that's sleepy. I think those are very impressive numbers. Next up here, Palantir. So I posted this inside the breadcrumbs chat a little before market closed today. It was a video, a gladiator, and he's like gonna hit the guy, but then he just throws a sword down, right? And I said, it's me struggling so hard not to cash some more Palantir shares right here, right? Because I got 1,000 shares left in the public count. At the bottom line is, in regards to Palantir, I don't see the stock being a moneymaker 2026 to 2029. This is my base case for Palantir. 40% revenue growth goes down 38%, 35%, 30%, 50% net income growth, 40%, 38%, 35%, right? 85 to 100 P, which is extremely high. Keep that in mind. Like that's a 4x and even a 5x higher PE ratio than where the market trades at, right? And in that scenario, the stock's flat. I don't make any money. And that's at an 85 to 100 P ratio come 2029. I don't make any money. Like Palantir's risk reward is just not there in my personal opinion. The hype's there and the excitement's there, right? And the growth rates are there in the short term here, but it's just the numbers don't add up but when you run it over the next few years. And I posted this on X. If you ever want to follow me on X, I always have that linked in the description area, all my videos. I said PayPal will outperform Palantir significantly 2026 through 2029. Bookmark this post. Very controversial statement right now, right? But guess what? 3 years ago, it was extremely controversial for me to be buying Palantir stock. Almost no one believed in Palantir stock 3 years ago. The stock had crashed 70, 80%, and I stepped in. I'm like, I think this company's product's amazing. I think they're going to be able to grow this business immensely over the next 5, 10 years, right? And the rest is history. And so now I come out with a very controversial statement that PayPal is actually going to outperform Palantir significantly. And I think Palantir is going to be a flat or down stock 2026 to 2029, right? I'm pretty confident in that. When I say pretty confident, I think there's a 90% probability Palantir ends up as a flat stock or down stock 2026 to 2029, right? PayPal's not going to be. PayPal's going to be a huge moneymaker. I think PayPal likely 2026 to 2029. I think PayPal probably doubles or maybe even triples or quadruples up its share price over those years, right? If you want to apply to join private stock group, private wealth group, get access to 1000xstocks.com, all that good stuff. Pin comment down there. We'll send you your Steel membership cards to your house once you join us in there. There's a private group card. We have the Steel membership card for 1000x. We'll send you that as well. And then if you join us on a lifetime basis, we'll send you your Steel membership card for the lifetime. I keep that baby in the plastic because it's just too darn beautiful. Public count was over $4.2 million here today, closed just under $4.2 million. Unbelievable. Obviously, we were trying to get this portfolio over 4 million for a while there, and then all of a sudden it exploded above 4 million, and now all of a sudden 4.2 mil here today. Congratulations to everybody out there hitting new all-time highs in your portfolios, okay? Alrighty, so we had a bunch to go through in this video. First off, Cake. Cake just came out with earnings about an hour ago. We'll talk about their earnings, my opinions, where's the stock headed from here. SoFi came out with earnings this morning. I'll go over what I saw that was interesting in regards to SoFi and where that stock is headed from here, my plans with it. PayPal came out with earnings this morning. We'll talk about the numbers. We'll talk about where I think that stock's going, those sorts of things. Okay, 3 major investments for me. Fourth thing we'll get into in this video here today is I spent $52,000 on a stock today. We'll talk about what stock that is, why I went ahead and did it. And then we've got a bunch of videos to react to in this one here today. Okay, first one up here, AMD CEO Lisa Su talking about the business. Then Palantir CEO Alex Karp went on with Jensen from Nvidia here today. Anthony Noto went on CNBC here today. And then Dan Niles made a massive call yesterday talking about you'll see 30 to 50% correction crashes in many AI related names next year. And he was been pretty darn on with his calls lately. I got to say that he's, so yeah, we got a lot to go through in today's video, folks. This is a busy action packed one. I appreciate y'all for joining me. One thing and one thing all I need from you guys, if you could just smash that like button for me. I hope you can do that for me, man. That's all I ask in return for doing these beast videos for you guys day in and day out here today. Additionally, if you want to be subscribed here to the channel, you can certainly subscribe. Sometimes people complain. They're like, oh, your videos are too long. It's like, look at a day like today. What am I supposed to cut? Like, Cake came out with their earnings, PayPal and SoFi. If I don't cover those earnings, people are going to be mad at me. Like, how am I not going to cover those? And then, what am I not going to react to one of these videos? See Lisa Su going on CNBC, I'm not going to react to that. Alex Karp and Jensen together, I'm not going to react to that. Anthony Noto, Dan Niles calling for 50% crashes next year. Like, dude, I know my videos are long, but most people that are subscribed to my channel thoroughly enjoy my long beast videos, and I'm glad you guys do, okay? So, yeah, we got all that to go through in today's video. Pinned comment down there. If you're looking to apply, join my private stock group, private wealth group, get access at 1000xstocks.com. We will send you your membership cards once you join us in there. Pinned comment, click on that, fill the form, join us in there. We'll send you your 1000x card and your Steel membership card for the private group as well. Got them right here with me. And then if you join us on a lifetime basis, we'll send you a lifetime card as well. Do keep in mind, demand's been ridiculous in there. We're now up to 2,702 members in there. I'm trying to slow way down on new members next year. So we're going to make a move to $100,000 or more net worth to get in the private group. So if you're under 100K, you'll definitely want to get in there in the next couple months. You know, I don't want people complaining next year saying, oh, you don't allow people under 100K. I've made several calls to action about this. So letting everybody know in advance. If you want to join us, do it now, okay? Or don't join us, you know, and that's on you, okay? Alrighty, guys, appreciate you. Let's get into this. Cheesecake Factory, listen, the cake. B plus income statement here overall. Revenues went to $907 million from $865. Keep in mind, the restaurant category is not in a good place right now. Let me repeat, the restaurant category is not in a good place. Look at Sweetgreen numbers, look at Chipotle numbers, look at Cava numbers, look at the other like sit-down restaurants. They're pretty bad right now. The entire like restaurant category is bad. So cake's still growing very nicely despite the sector not being in a good place, okay? They brought down food and beverage costs to 21.8% of revenue from 22.6%. And labor expense, whew, that's usually a big one, right? They brought that down to 35.6%. It's always the biggest line item from 35.9% as a restaurant, right? That is very impressive. Now, other operating costs and expenses actually grew to 28.2%. I'm not as worried about that because sometimes that's like more, you could have some one-offs in there, some kind of freak things that happen that maybe throw that number up. So actually these two line items, your food, beverage costs, and labor expense, much more important overall because, like I said, one-offs can affect this numbers, overall, right? General administrative expenses, they kept that in line at 6.5%. Depreciation and amortization went up slightly to 3% from 2.9%. Total costs and expenses fell to 95.9% from 61.1%, which is going to mean your profitability as a restaurant is going to definitely increase, right? Income from operations went to $37 million from $33 million. That's up to 4.1% of revenues, right? Net income went to almost $32 million from, a little under $30 million in the same quarter last year. Diluted EPS went to 66 cents from 61 cents. Do keep in mind that income tax provision, that hit hard, that doubled basically on a year-over-year basis. So keep that in mind. That definitely affected profitability. But despite that, despite the sector being weak, despite all this, they still grew, right? They grew their earnings per share. They grew their net income. They grew their revenues. No excuses. That's what I'm talking about. That's what I like to see from my companies. I want to see you put up the numbers regardless, right? North Italia. So North Italia are up to 46 locations. Do keep in mind they're talking about a potential of 200 domestic locations of North Italia over time. So we've got a long expansion opportunity ahead for North Italia. Comps had a rough quarter, year over year, down 3%. I'm not that worried about that. Like if that becomes a longer term trend, we see that play out for a year or two, then we got an issue, right? But, quarter by quarter, like sometimes comps will be really good and, you can't get too excited about it on the other side, right? Flower Child, they're up to 42 locations of Flower Child in 15 states. They're talking about taking that to 700 domestic locations. This is the biggest opportunity for Cake overall as a business model, right? And then additionally, significant off-premise volumes, averaging over 50% of sales are takeout sales, okay? So that's significant. We know we're in a day and age where a lot of folks like to eat at their house, takeout, right? We know DoorDash, Uber Eats, all that stuff has obviously been booming and will continue to boom for at least the next, decade. And so Flower Child's very well positioned to capture a lot of that business. It's not just about people going in there, ordering, sitting down, waiting for somebody to bring it. It's about they make orders on the app. Even my wife does that sometimes. And additionally, takeout business as well. I believe they have an exclusive partnership right now with DoorDash. Maybe over time they'll expand to Uber Eats and others, Grubhub. We'll see what happens with that. Okay. Now, they're talking about they keep expanding more and more locations, right? 13 new restaurants open in 2022, 16 in 2023, 23 open in 2024. This year, they're talking about as many as 25. They need to start going to like 50 plus a year. They got to keep accelerating quite significantly. I would love it if they could take it to at least 40 for 2026. And then after that, take it to 50 plus a year, right? We've got to bump this up. No, where's Cheesecake stock going from here? Well, it's going higher, right? It's going to be a steady riser over time, right? It's going to have little volatility here and there, but it's actually not a super volatile stock. It's just a steady riser over time. Like, it'll give back some gains here and there, then it'll go up again, then it'll give back a little gains, then it'll go up. But the overall trend is up and to the right for Cheesecake Factory, and that's what it is, right? Cheesecake's never going to come in with some shocking number where you're like, oh my gosh, I can't believe they just did blah, blah, blah number, right? It's not that sort of company. They just come in and execute. They trade at a low valuation, and the stock's a buy every single month until 2027. Every single month, right? And heck, it might still be a buy after 2027 as well. And it's been a buy for years now. You look at me, I got shares all the way back from 2023 in the stock, right? And I still continue to buy the stock on and off. I think I even bought some Cheesecake shares today, a little bit. I think in one of my portfolios, I literally bought cake today, if I recall. So this stock is a buy. It's a buy, and it's a buy, okay? SoFi. Oh my gosh. You want to talk about a flapjack flipper, look no different than SoFi. A plus income statement here. Loans and securitizations, as far as interest income, 830 mil from 671. Other, 61 mil from 51 mil. Total interest income, TII, 891 mil versus 723. As far as total interest expense, that went to 306 mil from 292. They kept that in check. That's very impressive. When your interest income's up that much, right? We can call it, what is that, about $170 million. And your total interest expense is only up, what is that, $14 million roughly? It's nothing. So NII, which is arguably the most important number to look at for like banking related companies, right? $585 million from 431, phenomenal growth. Now, as far as provision for credit losses, that one I kind of draw my attention a little bit there. That went to 9.1 mil from 6 mil, but it's still a low number, an absolute number, right? There was a big increase as a percentage, right? We can call it about a 50% increase, but as far as a raw number, it's actually really low. Total net revenues of the company went to $961 million. That also factors in non-interest income from 671 mil. But the big increases here, specifically this one, loan platform fees are making bank off that. That went from $55 million to $164. Business is blowing up. Look at over the past 9 months. That loan platforms fees went from $78 million to $385 million. That's Anthony Noto wanting to run this business asset light, right? Incredible numbers. Now, as far as income before income taxes, $148 million from $63 million. Net income went to $139 mil from $60 mil. That's over a double up there. And diluted EPS went to 11 cents from 5 cents, over a double up there. That is an A plus income statement there, an absolute banger from SoFi. As far as the amount of members, they're now up to 12.6 million members, customers, whatever you want to call them on SoFi. That was 35% growth year over year. Just in this quarter, they added 905 million new members, which is an incredible number because that's roughly half the amount in total they acquired in 2022, right? So basically, they're now doing in a 3-month span what just a few years ago they were doing in a 6-month span as far as new customers go. So they're doing a phenomenal job continuing to acquire more and more new customers. Now, where's SoFi stock going from here? Well, my opinion is the next 6 to 12 months, it's very simple. If the market's going up, if we're staying risk on, SoFi's going to continue to move up and move up and move up. If the market goes risk off, this one's going to get wrecked, right? It's going to get slapped hard, just like Palantir, Tuss, all the other kind of risk on stocks, right? But at the end of the day, you even see like this stock wanted to go down today and they wouldn't let it go down. People were out there buying it up, and it ended up finishing up 5.5%. We were up $8,300 today on SoFi stock. Now up $116,000 on the stock, up 281%, right? On a stock that I haven't even been in for that long. Like most of my shares I acquired was 2024, 2025. So like we're just making bank on the stock. It's going to, no pun intended. And as far as where SoFi goes long term, it's likely a $50 to $100 stock long term. But short term, next 6 to 12 months, it's all dependent upon the market. We stay hot in this market, SoFi will continue to shock you to the upside. Next thing you know, we'll be talking about a $35 or $40 stock. We go risk off, SoFi will get hammered. You'll see it go down 25, 22, something like that, right? PayPal. Net revenue is 8.4 mil from $7.8 million. Transaction expense grew, expenses grew, but they were not up that much. As far as customer support, sales and marketing, technology and development, they kept those numbers in check considering, revenues was up nearly $600 million year over year, right? Operating income went to $1.52 million from $1.39 million. Income before income taxes went to $1.53 billion from $1.31 billion, so over $200 million increase in income before income taxes. Net income went to $1.24 billion from just over $1 billion in the same quarter last year, right? They had another expense that really hurt them in the same quarter last year, whereas now they had a benefit there, right? And that's where I talk about these one-offs can significantly affect your profitability, right? Diluted EPS went to $1.30 from 99 cents. That's a grade A. What would make this an A plus would have been faster revenue growth, right? The revenue growth was good, but we really got to talk about strong double-digit revenue growth for me to say I'm going to give you an A plus, but that's a grade A, man. It's extremely impressive income statement there. You got revenue with, we can call it high single digit revenue growth, right? And you got your net income and your diluted EPS going up at a far faster clip, and you're keeping your expenses in profile like you're a grade A student. Phenomenal from PayPal. Now, something very exciting is going on with PayPal's business model right now, okay? I'm not sure how many people are looking at this, but this matters significantly, and this is why PayPal stock bottomed many months ago and why it continues to move up, okay? Look at this. If we go back, PayPal was on a consistent deceleration of revenue growth, right? It was obvious. And growth bottomed right here at a 1% revenue growth back in this quarter, right? Well, last quarter, they ended up growing revenue 5%. And in this latest quarter, they just reported 7% revenue growth. So now we're on a revenue acceleration phase for this company, which is usually a very fun phase. Like, I could show you just about any stock that goes through a revenue acceleration phase usually has a very, let's call it, fun stock price over that same amount of time. And so this matters significantly because you have to start adjusting your growth rates. There's a big difference between a company that you think is going to grow 1 or 3% versus 5% versus 7% or 9%. We don't know. Now we're in a phase with PayPal. We don't know how high the growth is going to go. We just know it's accelerating. Like what's next quarter? I don't know. Maybe it's 8%, 9%, 10% growth. We're going to have to see, right? Additionally, cash flow from operations came in at $2 billion and free cash flow came in at $1.7 billion. Adjusted free cash flow came at $2.3 billion, which excludes the net timing impact between originating buy now, pay later receivables as held for sale for the subsequent sale of receivables. Keep in mind, a lot of that buy now, pay later business, they end up selling off to somebody else. So they remain asset light. They don't like to take the long-term risk of that. So cash flows are booming for the company. Cash and cash equivalents and investments total $14.4 billion for the company versus $11.4 billion of debt. So they could wipe out that debt tomorrow if they wanted and still have a ton of money around, right? They returned $1.5 billion to stockholders by repurchasing approximately 21 million shares of the stock in this latest quarter. On a trailing 12-month basis, they've returned $5.7 billion to stockholders, repurchasing around 78 million shares of stock. This is when you want to buy, man. PayPal stock's been dirt cheap, it's been, $50 to $80 for a while now. This is exactly when you want to be buying every share in sight if you're PayPal, right? Additionally, this was pretty impactful. They started Dividend, and they're planning to pay a quarterly dividend going forward. Now, you might say, what's the big deal with the quarterly dividend? Listen, there's a lot of individuals out there, a lot of investors that will not consider a stock that doesn't pay a dividend. Additionally, PayPal's a value stock, right? They have growth, 7% revenue growth in this latest quarter, but it trades at value valuations. Look at the forward P of PayPal. What is it, 12, 11, somewhere around there roughly, right? That's very attractive to value investors. Somebody that's a mega growth investor, they may look at PayPal like, I don't want PayPal stock. 7% revenue growth is nothing. I want a company that's growing revenues 50%. I want Palantir, right? Or I want SoFi, and that's fine. But if you're going to attract a lot of value investors, you gotta give that dividend. There's so many value funds, so many value investors that will not consider a stock unless it pays a dividend. So PayPal is now going to pay a dividend moving forward. And so a lot of investors will start to look at PayPal and say, you know what? I'm going to go ahead. I'm going to dip my toe in this one. It's a great value stock. They got a consistent business model. They're now accelerating growth, right? And it trades at extremely low trailing 12-month Ps, forward Ps, 2-year forward P, doesn't matter what you look at, right? So brilliant move by Alex Chriss. Alex Chriss continues to impress me. Obviously, this is something that has to go through the board of directors, but my guess is Alex Chriss has something to do with this as well. And also impressive that Alex Chriss is now accelerating these revenue growth rates. You know, people were a little skeptical of what Alex Chriss was up to a few quarters ago. So like, what is going on here, man? The revenue growth keeps decelerating. Now they're starting to see all the changes Alex Chriss put in place. And like, okay, we see what he was doing. Okay, we like him now, right? No, this was the biggest thing that happened today. This was bigger than the dividend. This was bigger than the revenue growth acceleration. This was bigger than the diluted EPS flying up and the basic diluted EPS flying up and the net income flying up. This was the biggest thing, okay? PayPal partners with OpenAI to let users pay for their shopping within ChatGPT. PayPal said on Tuesday that it's adopting a protocol in combination with OpenAI's instant checkout feature to let users pay for their shopping directly within ChatGPT starting in 2026. So if you're getting excited about numbers in 2026, we have some here, okay? PayPal is adopting the Agentic Commerce Protocol, an open source specification developed by OpenAI that lets merchants make their products available within AI apps, consequently enabling users to shop using AI agents. Meanwhile, OpenAI's instant checkout feature, launched in September, lets users confirm their order, shipping, payment details, and complete purchases without leaving ChatGPT. Customers can use their PayPal wallets for checkout, which the company said would enable it to provide buyer and seller protection as well as dispute resolution. The company is also providing technology to handle card payments from within ChatGPT using a separate payment API. Remember, ladies and gentlemen, okay, ChatGPT right now has a valuation of around $500 billion on it. In order for these latest investors to make money on this, they need OpenAI to become $1 trillion valuation, $1.5 trillion valuation, $2 trillion valuation, right? And a huge component of if OpenAI gets there or not is going to be commerce. They've got to become a major commerce platform over the next 5 to 10 years. Otherwise, it's going to be hard to justify that current valuation, right? And next year, merchants using PayPal products will have their products be discoverable on ChatGPT, starting with categories like apparel, fashion, beauty, home improvement, and electronics. Merchants will not need to build any integrations as PayPal will handle merchant routing and payments behind the scenes. That's phenomenal. That increases your likelihood of success immensely. You make it easier for folks. Much higher probability of success. The company said it is launching an agentic commerce suite that would let merchants feature their catalogs within AI apps, accept payments on different AI apps, and get insights about consumer behavior. PayPal has been working to insert itself in payments partner with various AI companies, such as they did deal with Perplexity, right? They also did something with Google's agent payments protocol. So, you know, you got to understand, like, how did PayPal become such a massive platform where they have 400 million users or whatever it is, right? One of the big ways they did that and achieved that is back in the day, they partnered with eBay. They used to be like this with eBay, and then they ended up owning eBay over time, right? And eBay was a huge growing platform in commerce 20 years ago, right? 15 years ago, 25 years ago. Like, eBay was it. They were growing substantially. And so PayPal and eBay became like this. And if I even recall, there was a time when it was like hard to use anything to check out with eBay other than PayPal, right? So now PayPal is looking, they say, hey, you know what? We see the opportunity for these AI companies to be the next massive companies as far as commerce goes, right? And transactions, these sorts of things. Let's get in early with them. Let's partner early. And so you want to partner early rather than late with these companies. You're going to get first mover advantage there, and you'll build a much closer relationship with companies like this, right? Huge for PayPal. Now, PayPal will not be the only company, in my opinion, to partner as a digital wallet for ChatGPT over time. But when you're the first mover, you get that first mover advantage. That's why it's called the first mover advantage, right? And so that's going to be substantial for this company over time. Now, as far as PayPal, what are my projections for PayPal? Bull case, base case, bear case for this company. My bull case for PayPal has them only doing 9% revenue growth. This isn't something crazy. Like, they've been accelerating from 1% to 5% to the latest quarter 7%. Who knows where that's going to continue to accelerate with? And then 2026, they start to benefit somewhat from these AI platforms as well, right? But I'm doing 9% revenue growth, 11% net income growth. That gives me a 16% net income margins come 2029. 20 to 25p is very fair for a company growing almost 10% revenues and 10% plus net income. That gives me a stock that's somewhere between 156 and 195. I think PayPal closed at like $73 today or $72 or something like that, right? Base case for PayPal, 7% revenue growth, which is what they just did in the latest quarter. 9% net income growth, which is significantly under what they actually grew in the latest quarter, right? 18 to 23 Ps, easy peasy lemon squeezy for a company growing at these sorts of growth rates, right? That gives me a stock that's 130 to 167, so we can call a double up from here, if not over a double up. In bear case, I still get a good compounded annual growth rate on this company, right? It's a buy. PayPal's a buy today. It's a buy yesterday, it was a buy tomorrow, it's a buy next week, it's a buy next month, it's a buy for the rest of the year, it's a buy next year. Bottom line in regards to PayPal. So what stock did I end up putting about $52,000 in today? Well, I announced it in my private stock group. I bought 500 shares of PayPal in one of my private portfolios. And then additionally, I made a move in the public count. I took down my Adobe position just a little bit, about $10,000, and I put $10,000 into PayPal, or just over $10,000 more into PayPal essentially. So, brought my exposure up a little bit in regards to PayPal. I like it, man. I like it. They're doing well. I think it was a question mark 6 months ago, 9 months ago. I think a lot of people were questioning Alex Christ. Is he actually going to pull around this turnaround? Like, you don't know, the numbers are getting worse. Now the numbers are just getting better. The partnerships, it's like they're starting to partner with so many different folks. Like, they did that big deal in what was it, Saudi Arabia and the Middle East here recently. Now we got the OpenAI deal. They got the Perplexity deal, the Google deal. Whew, they're rolling, man. They're rolling. So he's pulling it off. And, bright days ahead for PayPal over the next several years. AMD.
You. I mean, it's getting ridiculous at this point, but I'll do it again. Congratulations, Lisa Sue.
Good morning, Jim. Good morning, David. Good morning, Carl. Great to be here with you guys this morning.
Well, let's talk about this deal. This sounds like something that I would never expect from the government. It is almost like TVA. It's the government saying, listen, we can't wait. We have to do this, and we have to do it now. And it sounds like we have to do it now because you're able to deliver something, next year? Is it really? Can we done that fast?
Absolutely, Jim. So we were super excited to announce a new partnership with the Department of Energy. Secretary Wright has been really leading this, with such an ambitious vision of what we want to do in AI for this country. So we announced 2 new supercomputers that use our latest generation AI technology. And the key is, the focus from Secretary Wright was, let's do this as fast as possible. We have so many researchers in the nation that want more computing. And so, yes, we're going to develop 2 supercomputers. One of them will be deployed early next year, and then the other one will be deployed with our next generation MI400 series. So fantastic partnership, and I'm really excited to be able to contribute to this really important mission.
I don't mean to belittle it, but I got to talk a little horse race. I think the MI400 is in some ways equal to NVIDIA. I want to know whether this was a contest and you got this and NVIDIA did not.
Well, as you know, Jim, I mean, this is a place where the national labs are truly a national treasure for the United States. Oak Ridge National Labs has been a great partner for AMD, and you can imagine everybody would want their compute in a national lab. So MI400 series is fantastic. We've been working across the board, across all industries, all of the national labs, all of the sovereign countries, and I'm super excited to be able to deploy both our current generation MI355 and our next generation MI430 at the Oak Ridge National Labs through these 2 supercomputers.
Sometimes you got to wonder, does AMD, and this is an important point, listen, is AMD able to outcompete NVIDIA on certain deals because they're smaller and the deals make more sense to them? Like, you see a $1 billion deal, right? That's significant for AMD. Is it significant for Nvidia? No, it's not. So would Nvidia fight hard for a deal like this? Maybe, or maybe not, right? Whereas AMD's like, we're going to fight for that deal. So there's a lot of these smaller deals that AMD will likely go after and probably win because they're just going to compete harder for those deals. Because Nvidia looks at it and like, man, we're doing such insane numbers with all these companies. Like, what does it even matter, right? You know, look at this. Sony's working on their next generation console with AMD. Xbox is working on their next generation console with AMD, right? Like AMD's just in a place where they're able to, I think, outcompete Nvidia in a lot of places that maybe Nvidia would want, but it's just like, it's not really material to their business. And sometimes it's just like they let these potential deals go, right? Or maybe it was different. Maybe Nvidia fought just as hard as AMD, but AMD had a better product or a better price or something like that. That could be too, right? But I think there's a lot more to be said about AMD is going to be able to fight harder for these smaller deals.
What caught my eye in the AMD release is that this is not just for traditional supercomputing for tech. This energy, medicine, health, national security, this to me sounds like a government initiative to stay ahead of everybody else in the world in all of these verticals, not just traditional data center compute. Can you tell us how, if I were, say, Thermo Fisher, or if I were Eli Lilly, I would be able to get into this and say, I want some of that compute power?
You're absolutely right, Jim. This is actually a non-traditional partnership between the government and industry. What we thought to do was, number one, we want to get as much compute as possible, as quickly as possible to the national labs. And they're going to do all kinds of research in medicine and energy and national security, which is wonderful. But we also said, there are industries that would, private industries that would like access to some of this compute as well. So the Eli Lillys of the world, the Thermo Fishers, all of these folks would also be able to participate as we bring up these clusters. And it is a very unique partnership. I would say, Secretary Wright said it best. This is the first time that he's announcing something where, the very first time I met Secretary Wright, he said, hey, bring me ideas, Lisa. Bring me ideas that get us more AI in the government faster. And I have to say, he was very open. We love the partnership with Oak Ridge National Labs. Our engineers and scientists are really, really excited about contributing at the national scale for our U.S. AI efforts.
The other big story, Lisa, that made news regarding you guys in recent days was IBM saying about 4 days ago that one of their key quantum algos run on chips from you that are pretty commonly available, and it's raised a lot of questions about the possibility of commercializing those powerful computers.
Well, we are also very excited about the partnership with IBM. And in general, when you think about quantum computing, people were thinking that quantum is, it's going to take years to develop. And when you really think about it, we're not in a place where we can wait years for these developments. We want these developments, really making a difference now. IBM and AMD announced this quantum computing partnership. Our researchers have been working together. And the key is we're going to take the best of classical compute or traditional compute, which is what we've spent all of this research and development on, and the best of IBM's quantum computing, and really putting them side by side in applications. So thinking about how we solve the biggest material science problems, how we think about some of the biggest energy problems, and this is an area where again, when I think about the work that we're going to do with DOE, I think it's going to continue. It's going to be across all of these fields, including how do we get quantum used in these new workloads as soon as possible. So this is kind of the world that we're in with compute today. It's all about speed and how do we get the most compute on the most important challenges as soon as possible.
Lisa, it's David. Just sort of more broadly speaking here, it's not as though other companies aren't developing plenty of chips as well, whether it's Amazon with the Trainium or Google and the TPUs and Meta. I'm just sort of curious from your perspective in terms of especially the inference market, but over time here, does the addressable market for AMD start to shrink as a result of all these potential competitors?
David, actually, it's exactly the opposite. I think what we're seeing is that the addressable market for AI and inference is actually increasing. We're seeing an acceleration of the use of AI, because as models get better, as enterprises are thinking about how they can deploy these models, there's a lot more compute that's necessary, and we're seeing that across the board with the CapEx spending as well as in our direct conversations with customers. And David, I think the most important thing for people to recognize is a big market is good for all of us. That has been our mantra, is to develop technology that can go across all of these verticals. And I love seeing our technology in the national labs and also across all of these enterprises and the cloud.
Yeah, so I don't have a lot to add there other than AMD and Lisa Su are continuing to execute the way I would expect them to execute. Phenomenal. Alrighty, next up here, Alex Karp and Jensen.
Actually to provide business decisions. And Alex, I'm actually going to start with you, the CEO of Palantir, just to explain, does that mean no human intervention? Can you just explain how this would work and use Lowe's as an example?
Well, first of all, I'm delighted to be on the stage with what many people I believe to be one of the great entrepreneurs of my lifetime and a patriot. And it means a lot to me to be here. So we have a product called Ontology. You could think of it as essentially a digital representative of your enterprise, including security model, which essentially takes the disabilities out of large language models and allows you to move decision-making to the front line with people, without people, depending on how you're doing it. In the context of Lowe's and other enterprises, it allows you to essentially automate decision-making, like how would your supply chain work? How would it work if it changed? How do you get the cheapest good to the right place, given that there may be disruption? But in general, what's very, very special, I believe, about our partnership is we're going to be able to move 2x, and I think in the future even faster. So you get a much, much faster, and actually because you can control it in a more granular way, much faster, much cheaper. And then the macro thing that I'm actually most excited about, which for our country is, because of that, you can do manufacturing in America, you can make the workers stronger and better, and you have more competition because you can use open weight models, open source models. You can use any hyperscaler. You can decide not to use a hyperscaler. This is much, much better for America, much better for workers, much better for industry. It's cheaper, it's faster, and obviously they have one of the world's top tech teams, and we work very well with them.
Before we go further here, you may say, how did Palantir stock not really move today? Like, it was up 0.2%, right? On, a big deal. The fact that Alex Karp is, sharing seats with Jensen, right? The center of the universe, like, that's a big deal. Why is the stock only up 2%? Here's why. Palantir has priced in a lot of good news. The valuation has exploded. Everybody's waiting now on Palantir's earnings and to see what that revenue growth comes in at, right? People are trying to see, is it going to start decelerating? Is it going to accelerate more, right? Are we going to go to 50%, 55%, 60%? Like, what's going to happen here, right? That matters much more than, Alex Karp being on a stage with Jensen, right? And doing an interview with Jensen. It's big, but it's not stock price moving at this point in time. We got to see what the revenue growth is. If the revenue growth accelerates to another level higher, then we'll talk about the stock approaches 200, right? But we got to see that. If we don't see that, then Palantir stock will start to slowly break down.
And just in regards to that collaboration, then who would actually be procuring the hardware? Is this like a company like Lowe's? Do they have to put the upfront cost, with their existing GPUs and then working with Palantir? Is that how it works? Or
first of all, it's amazing to think that the Palantir Ontology platform has achieved all of this, and they're the fastest enterprise growing platform in the world. In a lot of ways, it gives enterprises what we all want, which is intelligence and the ability to make good decisions fast. And now we're going to supercharge it with NVIDIA's accelerated computing for the first time. And so NVIDIA's CUDA accelerated computing is going to get integrated. We're going to be able to put NVIDIA's AI libraries on top of that and open source model that we're working on together into the Ontology platform. And you'll run it in the cloud, any cloud, or you run it on-prem or even a private cloud. And so, as you know, NVIDIA runs everywhere. And so you could buy a server from HP or Dell. You could be in another country and you want to set up your own private cloud. We got no trouble with that. And so it doesn't matter. We run everywhere, and Palantir runs everywhere.
But you're talking about the future then. So this isn't something that would be accretive to revenues just in the near term. You're still working it out. And I know Lowe's is an example, but are there other customers?
Well, at Palantir, we just do what's best for our customers. We work downstream for value creation. So what we believe, we know when it's faster, better, more accurate, and more flexible, and creates a better future for them because they can choose how they want to run their applications. we'll do very well. And at Palantir, we're doing very well in revenue and profit, and that's not actually our primary motivation now. And the reason we've done so well on profit and on growth is because you just have to create value. This creates more value for the end user.
But you just said before, too, that the human may not even be involved with some of these decisions. And I guess that is a major concern in this day and age, that AI efficiencies could take away from or displace.
Kind of strange. Alec Karp just took that, she was asking Jensen, and then he just took that over there. A little strange, right?
Job force. So couldn't something like this collaboration do that?
It's interesting. When you say humans don't have to be in the loop, that doesn't inherently mean there aren't cases where humans need to be in the loop. For example, 40 years ago, we had 40x more manufacturing jobs than we have now. So it's you can make more manufacturing jobs, which are humans, working class humans. You can build things you couldn't build in the past. And those humans become more and more valuable than they were in the past. In the defense context, you have situations where humans have to be in the loop, offense, situations where humans shouldn't be in the loop, like defense. Our collaboration makes all those use cases better for workers, for manufacturing, for defense, for offense, and in general, because it allows people to use any kind of model, any kind of compute structure. It makes America stronger and better.
Whenever a business is more productive, whenever they can move faster, their business grows, they hire more people. And so I think this idea that AI is going to take jobs is going to change everyone's job. That's for sure. But I think it's going to make companies more productive. We're more productive today because of AI. We're hiring more people.
Yeah. So let me give my opinion on, is AI going to destroy jobs, and are we all screwed? And those sorts of things. Listen, the truth is, AI will displace a ton of jobs over the next 5-10 years. No debating that. But there's going to be so many jobs created. In the end, it's going to be ridiculous. So many industries will boom and jobs will boom that you never saw coming. You're like, wait, how did this happen, right? No different than he talks about, everybody used to work in the factory, right? My granddad, he used to work for a company named Johns Manville, making asbestos products, right? And that was a job that he did for a long time. I don't know if he worked there at that factory for 10 years or 20 years or 30 years. So it was a long time he worked there, right? And that was his main income. And he had other side businesses and things like that, right? But that's what he did. And so that job doesn't exist now, right? But any other jobs do exist, right? My real estate marketing company, when I started that, photos and videos for the internet, for homes that were going up for sale, that wasn't a job that was even possible 10 or 20 years prior to that. But the internet age changed everything. Smartphones changed everything, right? And that became a job, right? Software is like my 1000xstocks.com. Decades ago that wouldn't have existed. And now it exists, right? And I have people that work for me and make incomes from that and all that stuff, right? You look at Palantir, that massive company that's been created over the past couple decades here, and look at what they've been able to do, and look at how many people work for that company, right? That maybe used to, make shoes. Or Nvidia, look at how massive Nvidia is, and look at how many employees that company has, and how many people work for that company, right? Despite all their fancy tech that might have used to work, I don't know, fishing out in San Francisco or something, you know what I mean? It's incredible. So technology, it will displace jobs, but it'll create massive amounts of new jobs. And whatever's new and created actually ends up being a far better job than what people were doing previously, right? I don't think any of us want to go work at the steel mill, do we? I don't think so. So, alrighty, next up here, SoFi CEO, Anthony Noto.
Some nice earnings there. We're looking at the stock this morning. Help us understand what's driving this, and then we can try to maybe look out into the future to understand a little bit better what 2026 may portend.
Sure. Well, thanks for having me on this morning. We had an exceptional quarter in every way. What's driving our growth is our unique strategy. We're the only place that on a digital platform you can get all your financial needs served across big decisions that you'll make, like buying a home or paying for college, day-to-day activity like a SoFi money account or investing for your future, or needing a charge card to pay at the point of sale. That diversification has driven really strong member and product growth. Our members grew 35% year over year. Products grew 36% year over year, and that manifests itself in revenue growth of 38%. We've been public for 17 quarters, and every quarter of those last 17, we've achieved the rule of 40 or more. We've averaged about 58%, and that's taking your revenue growth and your EBITDA mark. And this quarter was 67. So it's a combination of durable growth, innovation, and brand building.
So, Anthony, what is the product right now when you look at sort of the multiple different products that you offer in terms of the tip of the spear that's bringing new customers into your ecosystem, which then you're effectively selling, and upselling them other products? What is it that's happening here?
Sure. SoFi Money is by far one of the things that are at the tip of the spear. We have 6 million members. It's a very unique offering. It's the best of checking and savings in one. We give high interest, about a 3.8% APY today. We charge no fees. We provide reward points. You can pay anybody, anywhere that you would like. You can pay via an email address, via a phone number, via your debit card, via ACH. You can now do instant wires as well. So we try to deliver the best place to save, the best place to spend, to do it safely, quickly, and cheaply. In addition to that, you also become a member and you get free certified financial planning, because we're trying to help you spend less than you make and invest the rest. Half of the Americans in the United States don't invest.
Hey, hold your horses. There's just one flipping flapjack in a moment. What's the number one key to being a successful investor in the stock market that Jeremy Lefebvre says all the time? More income than expenses, right? More income than expenses. That's half the battle. You do that? Okay, now we can talk about income statements, balance sheets, forward PEs, run projections, right? You don't have more than income than expenses. Whew, it's going to be tough. And
it's primarily because they have no discretionary income to achieve their goals. So that is at the tip of the sword. Another product, Relay. Both products are over 6 million products, both Relay and SoFi Money. Those are the tip of the sword. And then we drive about 40% cross-buy. It was a record this quarter because we have this breadth of products. We're using information that we have about you to help you borrow better, save better, spend better, and invest better. And so that
let me mention another key product here that SoFi has that has been definitely attracting customers that they've been kind of undercutting on, at least from what I've seen, is personal loans. And so what people will do essentially is, let's say somebody's got $10,000 in credit card debt. We know credit cards have insane APYs, right? Like 25%, 28%, something insane, right? SoFi might offer an individual, if they have good enough credit, right, basically a personal loan for $10,000 at maybe 9%, 10%, 11%, something like that, right? And SoFi goes ahead and does that loan, right? And then that person uses that money. Hopefully they use that money to go pay off that credit card, right? And now they just switched from a 25 or 28% interest rate down to 9%, 10%, 11%, whatever they have to pay SoFi, right? And then what SoFi can then do, they can also then go ahead and sell off that loan risk if they want, right? Which is something they might do. They might say, you know what, we don't actually want to take that risk. We want to start this loan, but now we don't want to take that risk, so they sell it off to somebody else. So, there's a lot of ways that SoFi can acquire customers, and they're doing a dang good job because they just added nearly 1 million new customers just in the quarter.
Taking share from? If you were sitting around on a Monday morning with a whiteboard,
traditional banks,
looking at sort of who you actually think of as your competitor set today, who is it? Because obviously there's the banks, there's a number of the digital platforms. I mean, I'm just curious what you would. I won't answer. What do you think?
Yeah, it's not what I think, it's what I know. We can actually see where the money is coming from directly every day, and it's really coming from the banks. In the United States, there's over 5.
Like, no disrespect to the gentleman asking the question, but come on. Where do you think it's coming from? Like, where do you think he's taking the market share? Out of the sky? Like, of course, he's coming from traditional banks. It's coming from people that maybe would have went Wells Fargo, Bank of America, Chase, whoever, right?
Banks. The large banks have trillions of dollars of deposits. We're at about $33 billion of deposits today. We added a record of $3 billion of deposits. And those deposits are coming from the big banks, the largest banks in our country. And that's on the SoFi Money product, which, as I mentioned, is the tip of the sword. In Invest, we're really actually creating new investors as well as novice investors and helping them get up the learning curve. Within student loan refinancing, we really don't compete against anyone because it's a product that's not really offered by big financial institutions. I would say in mortgage, the big banks do not offer mortgage to everyday Main Street customers.
That's actually true. Yeah.
And so in each product category, the competitor is different, but overall, it's the big banks.
Right. Okay, I don't know if you saw.
Yeah, I don't know if a lot of you guys know. A lot of you can't even get a mortgage from like a big bank. Like, they kind of shun that business away. They're either not involved or they kind of like don't want that business, which is intriguing, right? Like, you would think like, oh, I bank with Wells Fargo, or I bank with Bank of America, I bank with Citibank, I bank with, JP Morgan Chase, whoever. That's who I'm going to for my home loan. A lot of them are like, not talking to us about that. We're not interested in that. interesting. SoFi's like, oh, we'll take that business. That's fine with us, right? We're not going to shun that away.
This morning, and I don't know how early you've been up because I imagine you're on the West Coast, but PayPal and OpenAI just announced a partnership where you're going to actually be able to effectively pay for things using PayPal inside of ChatGPT going forward. And to me, this has huge implications for the entire sort of financial community because there's a question both of the opportunity set to effectively partner with some of these large language models and chatbots, but there's also the possibility of remarkable amounts of disruption that could ultimately take place. How are you thinking about that?
Sure. There are two technology super cycles happening at the same time, both of which that impact the fintech sector and SoFi specifically. One is AI and the other is blockchain. We launched this quarter SoFi Pay, and you can now send dollars from the United States through a level 2 blockchain via SoFi to someone in Mexico and have it convert into the local fiat there in pesos. We'll roll that out.
Love it. I love SoFi continue to innovate with stuff like that. Like, just another way to acquire more customers, right? There's plenty of people out there that need something like that, right?
The entire world, and then we'll take the SoFi Pay app, which will allow you to pay not just via blockchain and stablecoin, which SoFi will issue, but allow you to pay any other way that you would like to. So it's a universal payment capability. So we're going to put the SoFi app in these foreign countries to allow international payments to be made. What I'd say about these press releases with ChatGPT and others is we're launching products. We're not putting out press releases. There was one yesterday about a stable coin with a big bank. Let's watch what people actually launch and the impact that they're having. The reaction that we got from U.S. consumers and our members from launching international remittance, cheaper, faster, and safer than the current mechanisms, was really positive. And so you'll continue to see us innovate behind both AI and blockchain. One thing that we didn't talk about is that we will be the first national bank in the United States to launch buy, sell, and hold crypto on our platform. First national bank to offer that by the end of the year. We'll launch a stablecoin in Q1, which will help us really drive faster, cheaper, and safer payments as well.
I mean, SoFi's just a stock you got to own, is it not? Like, it just is. I'm so happy I built a position in that stock. Like, you know, Anthony Noto is just in that team, right? It's not just him, it's his whole team there. They're just executing. They're innovating quickly. They're launching new products and services that people love, and it shows in the numbers. Like, if the customers didn't love it, like, they wouldn't be acquiring all these members, and their revenue wouldn't be skyrocketing, their profitability wouldn't be skyrocketing like this, right? Like, they're launching new stuff, they're acquiring tons of customers, they put up their numbers, and I'm just a proud shareholder. Like, I don't know what else to say, man. I'm just a very, very proud shareholder of SoFi. And yeah, stock's going to $50 to $100 long term, in my personal opinion, right? Short term, that depends on where the market heads here, risk on, risk off, because it's definitely a risk on, risk off type stock. Dan Niles.
Just to kick things off, how are you thinking about...
Before we get into this, by the way, Dan Niles, he made a great call. I think it was either a month ago or a couple months ago, and I reacted to it here on the reaction channel, Jeremy Lefebvre Makes Money, right? He said the market was going to rally all the way to Thanksgiving. I mean, gosh, like, that call's looking pretty freaking good right now, right? If the market continues to rally all the way to Thanksgiving, like, he was 100% on, right? Like, that was an impressive call. I got to say, if it ends up playing out, we got to see how things finish out in, you know, not only this month, but in November. But geez, like, as of right now, that call from a couple months ago, that's looking right on.
Week ahead, especially in light of all these kind of idiosyncratic pockets that we're seeing, stocks rise today, for example, Qualcomm.
Yeah, I mean, the way I'm looking at it is over the weekend, you obviously had trade deals with 4 different countries. That was a big positive. On Wednesday, you get the Fed meeting where you're going to get a cut. And you could argue 2 cuts in the sense that I think quantitative tightening will be stopped. And then obviously you've got 25% of the S&P 500 reporting between Wednesday and Thursday when 5 of the 7 Magnificent 7 report. And then Thursday you should have that meeting between President Trump and Xi, and you should get a framework for a deal there. So I think all of those things are going to drive stocks higher in a broad-based rally, and I think that's how you want to be positioned.
Do you think that the bias is to the positive, that investor patience over higher CapEx will be tolerated as long as revenue is higher, as long as there's a framework for a deal, or as long as tensions just don't get exacerbated from here?
The big thing is when you have easy money, money flows everywhere. Everybody's assumed to win. And as you brought up earlier, Qualcomm now is assumed to be a big winner in AI, but if you notice, Nvidia, Marvell, and Avago, at least the last I checked, they were all up as well. So right now you're in this environment where despite investors going, well, how many have won in search? Well, it's just Google. How many have won in e-commerce? Well, that's just Amazon. What about streaming? That's just Netflix. What about audio? Well, that's Spotify. Right now, the assumption is everybody's going to win because you've got this easy money. You're going to get a rate cut, going to get quantitative tightening probably stopping. You'll get another rate cut on December 10th. You'll probably get another one to start next year in January. And then you're going to get a new Fed chairman in May that's going to want even more rate. Right? So we've been through this scenario before in 2021. Inflation went from 1.4% to 7%, and the S&P was up 27%. And so you're in that same exact environment where everybody's going to win, enjoy the party as long as it lasts, and then prepare for a hangover sometime late next year.
Right, I was just looking.
Big call by Dan Niles. He said, prepare for a hangover late next year. So basically, that's him basically saying, we're going to actually be party on all the way to late next year. That's a big call. That's a big call. So basically, if that's the way he's viewing it, he's viewing us as in late 2020 right now. And then we had a topping of a lot of the high valuation speculative names. We had a topping of those stocks around February of 2021. But overall, the market kept going higher. We had the meme craziness in the summer of 2021, AMC, GameStop, all that stuff. And then big tech actually continued to rally all the way until it peaked November 2021. And then we had a massive hangover after that, right? So that sounds roughly what he's talking about here. Very intriguing.
Last time the Fed cut, Dan, with inflation at these levels, October 08, right? So how much are you worried about the other side of that mountain, as Tepper might say?
Oh, the other side of that mountain is going to be horrific. I mean, I believe that sometime late next year, you end up with a 30 to 50% correction in a lot of these AI-related names. But it doesn't mean, Carl, that between now and then, these stocks can't go up another 25, 50% or more, because you've seen this same picture show in the late 90s. And back then, the Fed was actually raising rates, don't forget. And the market still ripped. NASDAQ was up 86% in 1999, and then it started 2000 up 24% in just over 2 months. Obviously, the hangover on the other side was terrible, but you made a lot of money just sort of staying with it as long as the government kept screwing up and making, as long as you had investors believing everybody's going to win. And Qualcomm today, for me, the interesting part was all the competitors were up. And so we're still in that great mode of, hey, we've got all this money flowing into the market. It's going to find its way into all these different stocks.
Yeah, I feel like we should give investors a little more credit, though, because we have seen some dispersion, particularly in internet more recently. Netflix and Spotify down about 9% over the last month. We saw what happened with software, especially in the early days of AI, where investors were kind of thinking about how AI could eat their lunch. I mean, do you expect some choppiness in places like internet and software that could be disintermediated by AI?
I mean, here's the bottom line. You're going to see some companies do worse than others. Obviously, the 5 that are reporting coming up, Apple and Amazon, they're up about 3 to 6% year to date. You look at the 3 that are reporting on Wednesday before those 2, and Microsoft, Google, and Meta, they're up between 25 to 40% year to date. But what I'm saying is, for an investor that's not doing this 24/7, if you look at just the broader market, since the Fed cut on the day before the Fed cut on September 16th through last Friday, you had the Magnificent 7 up 2% on average. You had the S&P up 3% on average. The Russell 2000 is up 5%. So I think right now you're in this phase where, now that you've resumed rate cuts, because don't forget, the Fed was on pause for 9 months. It's the more speculative areas of the market that care about rate cuts, the unprofitable segments of the Russell 2000. And you're seeing it where these stocks are levitating. And so I think you've got, to your point, Leslie, you've got a lot of company specific risk. If you have a disappointment, we saw that with Netflix results, right? You're much better off just being broadly diversified and saying between tariffs, deals getting struck, rate cuts, a new Fed chair in May, just be diversified and just enjoy that way rather than taking a lot of company specific risk where you might end up owning the Apple, Amazon, versus a Microsoft, Meta, Google so far. But, I think all five will do pretty well. Amazon I'm a little bit more concerned about, but I think all five in aggregate will be well this.
Interesting comments from Dan Niles there. Wow, I appreciated those comments. Okay. Once again, pinned comment down there if you're looking to reply, join our private stock group, private wealth group. Once again, January 1st, we moved to minimum $100,000 net worth to get in there. So if you have under that, make sure you get in there before that goes up. And then we'll send you Steel membership cards to you. You'll get access to my entire library of premium courses, access to 1000xstocks.com, access to exclusive weekly videos, access to see the stocks I'm buying and selling in my nearly it's well over $4 million portfolio in the public account now at this point in time. So look at that public account, almost $4.2 million here today. What a comeback. I mean, this portfolio is $1.2 million 3 years ago today. And now see it at nearly $4.2 million, very thankful for obviously what we've been able to achieve and all those sorts of things. Congratulations to everybody out there hitting all-time highs. I'm sure a lot of you guys hit all-time highs in your portfolio literally today. So congratulations to all of you guys, for staying focused and staying invested in the market, right? Incredible. 10 people in the private stock group last week, 10 people hit seven figures in their portfolio. So signed up 10 of those trophy boxes today. And then we had another 10 people hit six figures in their portfolio. So obviously it's amazing to see this sort of success. And this is what happens when you go on one of these big bull runs, man. People are reaching six figures, seven figures, eight figures. And then smaller investors are reaching five figures, right? They're climbing from that four-figure number up to five figures. And unbelievable to see the success out there, right? I posted this on X here today. If you ever want to follow me on X, it's always linked in the description area. And it's been kind of going a little, I would call it mini viral on X. It seems like so far. I said the public count's almost $4.2 million right now. If I sell it all right now, put it into a high yield savings account, I'd make $154,000 a year at 3.7%. Now, of course, taxes plays a factor, but for this little game, we're not factoring in taxes, okay? I said, would you be tempted to do it? Keep in mind, every 10% the portfolio goes up now is $410,000 plus dollars. And so if you think about it, like if we talked about all my portfolios together, I could make multi-$100,000 a year, never worrying about the stock market again. Think about that for a moment. Like that's, to some people, like, dang, that's tempting, right? Palantir stock is still on an absolute tear. Do you remember I did this video less than 2 years ago, buy Palantir stock and don't stop? I did that right here on this channel. It was $20 at that time, right? And I said it was going to 200. Well, the interesting thing about that is when I predicted the stock is going to go up dramatically I thought it was over the next 5 to 10 years. And here today, the stock's already getting close to $200, way faster than I thought, right? Knocking on the door at 200 here today. It closed at $189 on the 1,000 shares I still have left in the public count, up 2,478%. What a life changer of a stock, right? In this video here today, 3 core subjects we're going to get into. First one, why don't I just sell everything, cash out, and become a yield king, right? And just, buy treasuries, get 4% on treasuries, and just dip. We'll talk about that. I'm going to explain that. It's a very important subject, actually, because I think a lot of you guys are going to run into this position in the future where you're going to look at your portfolio and you're going to say, dang, I could make $50,000 a year, $100,000 a year, multi-$100,000 a year just being in treasuries or a high yield savings account. Why don't I do that, right? I'm going to walk you through my thought process. This is an extremely important subject we're about to get into. This is life, okay? Second thing we'll get into in this video here today is a position I sold 100% of in the public account here today. We're going to talk about why I went ahead and sold it, and I'm going to show you where I put that money, okay? We'll discuss that in this video here today, and upside, downside, all those sorts of things, risk profiles. Third thing we'll get into in this video is what if this market just keeps going up? We know November and December are usually amazing months for the stock market, right? What if we don't have the pullback that we could have had, right? We got no 2018. And what if this market just keeps rolling on? What do you do in that situation, right? A lot of people are already like, geez, this market's still so high, it reaches new all-time high. What do we do? So we'll get into all that in this video here today. I hope you guys enjoy this one. The only thing I need from you if you could please just hit that like button for me. That's all I need from you guys. I hope you enjoy me doing these daily videos, kind of keeping you up to date with everything going on in the market, my perspectives, and teaching you a little something out there with each one of these. That's always my goal, right? Not just to inform you on what's going on out there, but also to educate you on, things that I've seen over my 17 years in this market. If you just smash that like button, that means the world. Additionally, if you want to be subscribed to the channel and see more of my content in the future, make sure you're subscribed here. If you're subscribed, much higher probability YouTube will show my videos. And speaking about subscribe, you guys are all in the first 900,000 subscribers on this channel. We're about to hit 900,000 subscribers likely tonight or tomorrow. So I appreciate each and every one of you. And you guys can all say you were in before 1 million and you were even in before 900,000, man. Appreciate each and every one of you. Pin comment down there today if you're looking to apply to join my private stock group, private wealth group, get access to 1000xstocks.com, all my course curriculums, get your Steel membership cards mailed to your house, your 1000x, your private group. And then if you become a lifetime member as well, we'll send you your lifetime membership card. Those are brand new. Definitely looking to slow things down next year. We're now up to 2,689 members in the private stock group. Demand has been ridiculous. And so next year, we're making a few changes to slow down the amount of people coming in the private group. One of those being we're going to start to basically, everybody that's going to get in, basically you have to have at least $100,000 net worth. So do keep that in mind. If you're under 100K, you might want to get in there ASAP. And by the way, you might want to get in there ASAP no matter what, because there's other changes coming as well, right? Alrighty, so let's get into this. Why don't I sell everything and become a yield king? Very important subject, okay? Listen. When I was in middle school and high school, I loved to play a game called Madden, okay? This was a football game, and I loved to play this game so much. Oh my gosh. And for me, when I played this game, it was not just good enough I would do like what's called a franchise mode. And it was not just good enough to like, oh, I'm going to win the Super Bowl. I started making all these other things where I was like, let me see if I can go undefeated. Let me see if I can beat each team by even more points, right? Let me see if I can play on the very hardest mode. Let me see if all of my players can win like MVP and all these different things, right? Let's see if I can break new records. Like it was always like, let me see. And it was so much fun. And I would even go into practice mode and just like, make sure everything was perfected. Like this play is a perfect play, right? When I moved out of my parents' house, I moved to this community right here. It was a 1-bedroom apartment, okay? From there, I moved to Charlotte, North Carolina. This was in Glendale, Arizona. Then I moved to Charlotte, North Carolina, and I moved to this community right here, and I got a 2-bedroom apartment. From there, I moved to this community right here in Henderson, Nevada, where I got a 3-bedroom apartment. From there, I rented this house right here. It was a 2,700 square foot house. From there, I bought my first house. This was in Henderson. Nearly 4,000 square foot house. From there, I bought kind of like a vacation home in 2020 in Arizona, right? I rent that house out nowadays. From there, I bought the current house I live in Summerlin, Nevada, right? And that's almost 4,200 square feet. And now I'm building a house overlooking the entire city, right? That we'll be moving into next year. And even though I'm thinking about that house and moving in there next year, I'm also thinking about the next move after that. I'm thinking about the Summit Club, right? Which pricing will come down, in my opinion, over the next few years. And I'll likely buy a place in there in the next 3 to 5 years, right? I'm thinking about a property long-term, maybe in Newport Coast. I'm thinking about a place in Steinway Tower. I would love to have an amazing place in New York City, right? It goes back to the game. It's a game, right? A game of money. For me, I love the game. I love playing this game, right? And stacking the numbers up, building the numbers up. It's very entertaining to me. It's fun. Not everybody would not feel comfortable living this lifestyle. Not everybody wants to live this lifestyle. In respect, like some people, it's like, if they just got to $1 million, they're good. I don't care about playing the game anymore, right? They got to 2 mil, 3 mil. Everybody's got a different thing. For me, I love the game. I love the game of money. This is not stressful to me. It's not stressful for me to worry about, is this market about to crash or about to have a correction? Is the market going to blast higher? It's fun. I love this. This is like I thoroughly enjoy this to the maximum extent possible. So for me to say, let me go sell out of everything to go put it in a savings account, why? I love playing this game. It'd be like me playing a video game in high school or middle school and saying, I don't want to play the game anymore, even though I love this game so much. It's so much fun for me, right? Like, I love the game. This is everything to me. Like, I love this game, right? YouTube. obviously been fortunate to have so much success on YouTube. Got 4 silver play buttons. That means I have 4 YouTube channels that have hit 100,000 plus subscribers. And guess what? We just hit the 5th recently. My reaction channel, Jeremy Lefebvre Makes Money, that just became the 5th YouTube channel I've had since I started YouTube in 2016 to now have over 100,000 subscribers. So fortunate. The game, right? It's fun. It's fun. Public count, almost 4.2 million. I'm not even thinking about where the public count's at right now. I'm not even thinking about 5 million. You know what I'm thinking about? I'm thinking about 8 million. I'm trying to position the portfolio right now for the next double up, to get to $8 million, right? And to get through the next mess we have to get through, to then get out to the other side, to then go climb up to 8 million. I'm already thinking about that. I'm not thinking about 5 mil. I'm not thinking about 6 mil. I'm thinking about 7. I'm already thinking about 8 now at this point in time, right? When I'm bored with the game, I'll stop playing the game. And as of right now, I am not bored with the game. I love this game. I love the crashes. I love the corrections. I love the great markets, the bad markets, the kangaroo markets. I love it all. I love it all. So for me to say, once again, some people get stressed out about money. So they're like, dude, if I was in your shoes, I would just sell out and make $250,000, $300,000 a year, risk-free, not have to stress about it. That's fine. This your decision, right? But for me, this is not stressful. This is fun. I love it all, man. Even 2022, as sick as it might sound, when I was getting wrecked left and right? It seemed like every stock I had was going against me. It was still fun in the end. It's part of the process. We're playing a big game here. And, you might say, where's the game go? Long term. I got every house imaginable and I could ever have dreamt in every exclusive community out there, right? And my portfolio says there's a ridiculous number. Where's it all go in the end? It's going to go right back to society. It's going to go to charity. That's always been my goal since I started this game with a few $100 to my name. I always said, in the end, I would love to give it right back. And not give it to my kids, right? Because my kids, you think, and I understand a lot of people want to give back to their kids and they get a $700,000 net worth when they die. They want that to go to their kids. I, completely understand that. But from my perspective, my kids, if they want to make the most money in the world, they're going to be able to make the most money in the world, right? They're going to have all the knowledge from me when it comes to real estate investing, stock market investing, taxes. They have every connection they could. If they care about money like that, they could make more money than I ever made and just destroy my numbers. They could make me I'm 35 years old right now. They could make me look like a joke. They could, right? Because they're going to be starting with such a knowledge base that's, something I could never have dreamt of. So if their goal is to create massive businesses and massive investment, they can do that. That's their own thing. And then if they don't care about the money game, then they won't care about inheriting all that money anyways. That would just be a huge stress to them. Get it? Imagine, you don't care about money. That's not something that's important to you at all. And then you got to inherit a massive fortune. That's just a lot of stress on your shoulders. You don't care about money. And now you all of a sudden got all this money. That's stress. Not everybody's about that life, right? So they shouldn't need my money. So at the end of the day, that will go right back to society, right? And hopefully be able to do great things at that time. And what it is, we'll figure it out down the road, right? But that's always been my plan. I'm if I'm fortunate enough to live a full life and I want to keep going after this thing, that's what we'll do, So that is what that is, right? And as far as, we can call it medium-term stuff, I'm about to turn 36 here soon. I always thought about starting a hedge fund in my 40s. And so, I say, why don't I just do it right now? I think a few things. I want to have a lot more money when I go in and I start my hedge fund. I want to come in with at least, I would say 50 million to 100 million of my own dollars into the hedge fund, big dog money, right? I don't want to come in with 10 million. No, I want to come in with 50 to 100 million dollars to start my hedge fund, right? And I want to just continue to build a lot of equity with people out there. I want to hopefully make a lot of people, a lot of money by teaching them all the stuff I've learned over the past 17 years and hopefully take a lot of people that are 5 figures to their name right now to hopefully 6 figures and 7 figures over the coming years. And a lot of people that are 6 and 7 figures right now to 8 and 9 figures, right? Because then when other people are done playing the game, I'm sure there's no one in the world they would rather have managing their money when that time comes than the one right in front of you right now, right? And so, but that's a down the road thing, right? It's not something I want to do right now. And when I do it, I'll do it. That will be the moment. And until that, could I make a fortune doing that right now? Yeah, I can make way more money than anything I'm doing right now. But that's I just don't feel like doing it right now. Like right now, I love running 1000X. I love running the private group. I love doing what I'm doing on YouTube. There'll come a day probably when we go that route, but it's not right now, right? So that's why I do what I do. That's the longer term goals. I hope, if you wanted to learn a little something about me and like where all the money's going in the end, right? And all the houses and all the stocks and all that stuff, like that's where it'll all be going, right? Number 2 thing here. Position I sold 100% of in the public account here today, where I put that money. And we'll talk about what to do if this market keeps going up, okay? Alrighty, so I went ahead and I got spooked. I sold out of my Palantir hedge. Took about a little over a $1,500 loss on that one, PLTZ, and sold out of it completely in the public account. I got spooked, man. I haven't felt comfortable with this one the whole time. Here's the deal, okay? Palantir is on a massive revenue growth acceleration phase. Their margins are skyrocketing. Their earnings per share is skyrocketing. Everything, right? Their net income. And the main issue is the revenue continues to skyrocket, right? And it's, at some point this is going to peak and it's going to start to decelerate, right? But the issue is I don't know exactly what quarter that is. It might be in this quarter they're about to report. It might be in the following quarter. It might be in the following quarter. I would say it's likely in the next 2 or 3 quarters, but I don't know exactly what quarter that's going to be, right? When revenue growth peaks and then they start to decelerate. Now, when that deceleration phase comes, Palantir's stock's going to get obliterated, like 50% downside. But I don't know exactly when that is. And there's a potential here that if Palantir comes through with his next quarter numbers, and let's say they do like a mid 50% revenue growth, or dare I say high 50s, ladies and gentlemen, Palantir will see 200 easily. It might see 250. If they came through with a 60% number, because what ends up happening essentially is people start to extrapolate those numbers out. So if Palantir, let's say, grows the next quarter 55%, then people are going to think the next quarter they're going to go 59%, right? And then they're going to start saying, okay, next year numbers need to come up immensely. They're going to do 50% plus revenue growth next year. And people are going to say, oh my gosh, a SaaS company growing revenues 50+% with high margins and an EPS that's skyrocketing with a product that's, everybody wants their hands on. They're going to say buy, right? And, the stock will continue to roll up short term if that were to play out, right? So that's what spooked me here. I'm like, what if my timing's not right? And between now and the Palantir crash, whenever that comes, maybe the stock runs to 200, maybe it runs to 250, maybe it runs to 275, right? I don't want to go through that pain. Like, oh my gosh, right? That's going to obliterate, because I'm 2x, that's a 2x leverage against Palantir. You send that stock to 250, then we need so much downside just to get back to break even. So think about that for a moment, right? That's what spooked me in regards to Palantir. Now, Palantir, we know this is a ridiculous valuation. We know this does not make sense, right? The forward P on Palantir's well into the 300s. You send the stock up even higher, it's going to be even further into the 300s, right? But you got to understand we're in a Momo market right now. What's a Momo market? A Momo market is valuations don't matter, momentum matters. That's the market we're in right now, right? For me, I don't care what market we're in. Valuation always matters. But for most traders, investors, they don't care about valuations in a market like this. They care about where's the momentum at. What stocks are moving, we're piling into those. That's what they do, right? So Palantir, it doesn't matter that it trades at a crazy forward P, 2-year forward P, 3-year forward P. At the end of the day, if it's got the momentum and the high growth, people want in it. And so they just continue to funnel in, and that's what we have going on right now in this market, right? Now, where did I put the money? Well, I put the money in TSLZ. I went ahead and finished off my hedge here. So that's a 1% hedge for the portfolio. Portfolio right now is a little under 4.2 mil. It's a $43,000 plus hedge. So we can say it's roughly a 1%. Usually in Q4 of almost every single year, I like to hedge the portfolio, the public count, with a 1 to 3% hedge. Okay, I'm doing a 1%. So I'm done hedging now, basically for a long time in regards to the public account. Okay, now you might say, why Tesla, right? When this is a stock that essentially it's kind of like a Palantir in the respect of if the market has momentum, like Tesla will continue to move up. Yeah, that's an issue, right? This market keeps going risk on for the next month or two. I'll be sitting on big losses here. Like when I say big losses, I'm talking 15, 20%, maybe 25% losses in regards to this, right? But I'm very convinced that Tesla sets up much better than Palantir for downside risk when the market does start to move to the downside. The fundamentals are not there for Tesla. The fundamentals are there with Palantir. That's a big difference. Palantir and Tesla both trade at silly valuations, super high forward Ps. Both stocks have crazy momentum when the market's moving up, right? But here's the thing. Tesla doesn't have the fundamentals to back. The revenue growth is embarrassing, and that might go back negative again, especially given that now the tax credits are out, right? The earnings per share is plummeting for the company. It keeps plummeting quarter after quarter. You look at the latest quarter, EPS was down 30+%. And that was on a GAAP basis and non-GAAP basis. Disaster, right? The margins are awful for the company. So all the fundamentals are really, really bad in regards to Tesla, right? Now they've taken away the tax credits here last month, right? And look at like the search term on Google Trends for Tesla. It's in a massive downtrend now at this point in time. You can't give away these cars. Look at Tesla Model 3 Google's trend. Look where it's headed here. Look at Tesla Model Y Google's trend. Yeah, it got a nice spike up before the tax credits expired, right? And people were like searching, like, maybe I'll buy a Tesla because, they're about to take the $7,500 away. And now ever since that, it's just plummeted in regards to any interest in people like searching Tesla and Model 3, Model Y, those sorts of things, right? Additionally, and that's in the United States. Additionally, in China, by the way, in Europe, let me just say Europe's a complete dumpster fire for Tesla. Like no one wants Tesla in Europe after the stance Elon Musk took and all those sorts of things that we don't need to get into. But yeah, Europeans are their numbers are so bad in Europe. It's shocking. As far as China goes, their market share continues to decline significantly. They used to have 16% market share of the EV market. Now they're down to about 7%. And that continues to, plummet for the company overall, right? And then in terms of robotaxi, that's what people are excited about, right? Robotaxi is not going to generate this company any significant revenues or profits for years to go in the future, right? Tesla's barely at the stage where they want to start removing some safety drivers. You know what early stage that is? First, you got to then remove all the safety drivers. Then you got to prove out that your cars can run well and not have a bunch of issues with safety drivers. Because if they do, have issues and there's no safety driver in there, everybody's going to be posting that all over the place, right? People love to record these rides. That's going to be posted on YouTube and Instagram and TikTok and X. X might try to throttle it because obviously Elon Musk owns that platform, right? So they might try not to show that if it has some bad moments, but it will be seen on other platforms, right? And so that's a whole situation. You've got to prove that out. Then you've got to start getting approval in more cities around the United States. It's a long process. If you look at Waymo's years ahead of where Tesla's at, right? Waymo, they're only operational in a real way in 5 major cities. They have other markets they're testing right now, but the only markets they're really in are Phoenix, San Francisco, Los Angeles, Austin, and Atlanta, right? And they're testing right now in Miami, Washington, D.C., and supposedly testing in Tokyo as well, which is pretty exciting, right? But that just shows you how slow a process this is. And so then you got to market, then you got to get everybody aware of it, and then you've got to also undercut competitors, and you got to keep your product great. When I say your product great, I'm not just talking about get somebody from point A to point B safely. I'm talking about you got to undercut price on your competition, right? And you've got to have all your cars be clean, smelling good, all these annoying things that add up the cost immensely, right? That a lot of the Tesla folks have not factored in yet in regards to that matter. It's a whole big process, right? And it's going to take years to get the company to a place. And the funny part is people are going to find out when Tesla gets there is it's not going to be nearly as profitable as people think, which is going to be rather hilarious. But anyways, that's to play out. And you may say, okay, I'm very confident Tesla's going to eventually go through a bad spell in regards to that stock, right? Remember the saying, markets can remain irrational longer than you can remain solvent. So if you wonder, why don't I go big money, betting against Tesla here, 2x leverage, more than a 1% hedge. Why don't I go 10% hedge? Who's to say they don't just keep buying up the stock, even at ridiculous valuations? Anybody could pay anything for a stock. You can make an argument that Tesla's a crazy valuation at 150 PE, forward PE, right? So people are willing to pay 300 forward PE. Who's to say they're not willing to pay 500? Like, you know what I mean? Like, at the end of the day, that's the thing about the market. You never know when the next big roll down is going to happen. And at the end of the day, they just have kept buying up the stock. They look for the momentum. That's got the momentum, and they go rolling it, right? So, yeah, there'll be a day reckoning coming for that stock, but it's hard to get your timing perfect. And that's why when I hedge, I go small. And at the end of the day, if that hedge ends up being correct, I'll make a phenomenal return. Like if all of a sudden the market goes down, 10 or 15%, when I say the market, I'm talking the NASDAQ, over the next, let's call it over the next month or two, guess what? I'll cash out with a 50% profit on that, right? Be beautiful. And then flip that into long positions. But, November, December are usually great. Like, who knows? Maybe the market just continues to roll higher and Tesla just trades at even a more ridiculous valuation. Like, you never really know, right? So just something to keep in mind there and why I don't go big on that. I go big on sure things. When Tesla goes down is not a sure thing. I like to bet on sure things, companies that are at very attractive valuations that are going to have great growth in future years. I'm going to make a lot of money on, right? That's when I go big, right? Meta 2022. That's when I go big. Alrighty, next one up here. What if this market just keeps going up, right? Which what people are wondering, like, what do you do? Do you take profits? Do you not take profits? Do you stop buying? What do you do in this environment? Do you start betting against Tesla stock and Palantir? Like, what do you do, right? Okay, so here's kind of my 2 cents in regards to this subject. One, you take profits where returns don't make sense over time. So when you run your projected numbers, and I'll show you in just a moment, how I think about these projected numbers, right? When you run your case on a stock, okay, and you run those numbers, and at the end of the day, the CAGR does not say a very attractive return on your base case, you got to cash. You got to take profits in that stock. As bad as you might not want to, if the return profile does not say a good return, you take some profits. That's just the way it is. And part of the stock market is taking profits. Do keep that in mind, right? Most of the time, as a great long-term investor, you're just buying and holding, buying and holding, buying and holding. Selling doesn't happen that often. And usually, actually, when I sell, it's like a big subject, right? Like, oh, I sold the stock. Like, it's a big subject. Whoa, I buy stocks all the time. How often do I sell? Doesn't happen very often, right? So, but it is part of the game. And there's going to come a moment where every stock you end up selling at some point in time, right? It's just what ends up happening. People were debating today. I was watching CNBC. They were debating Berkshire Hathaway stock is going through a really tough time, right? I called that out years ago. So the day Buffett announces he's going to step down from that company, it's going to have a whole re-rating of that stock. And so even though the market's going completely risk on green, Berkshire Hathaway stock's doing horrible because it's not getting the Buffett premium anymore, right? And I explained that happened to Apple. I explained that happened to even Wynn stock with Steve Wynn. When Steve Wynn got kicked out of Wynn Resorts, had a whole re-rating of that stock. When you got some legend, I mean, if Elon Musk left Tesla tomorrow, stock's down 50% in a month, right? Like, it's as simple as that. When you got a legendary CEO in place, people are willing to pay a crazy premium just because that guy is in place, right? And so Berkshire Hathaway now, Warren Buffett's going to be leaving next year, and people are like, oh, not willing to pay what I used to pay for Berkshire, right? And so keep in mind, imagine if the market was in a downtrending market right now, Berkshire would probably be down 20 or 30% right now, right? Which for a great company like that's kind of crazy. But you got to run your numbers. If the returns don't make sense, you got to cash, right? 2, focus more on value and dividend stocks. When the market starts to get really frothy is just a fancy way of saying the forward P on the S&P 500 starts to get very elevated, which is what we're in right now. Focus more on dividend stocks and value stocks. That's where your best opportunities are, because when you're in a frothy market, people don't care about value stocks. They don't care about dividend stocks. They care about Palantir. They care about Tesla. They care about momentum. Look at stocks like Palantir and Tesla, since those are ones we're talking about in this video. Look at those stocks at the end of 2022. Where was Palantir stock? $7, $8, something like that, right? Where was Tesla stock going into 2023? About $100? Tesla stock was down like 70+%. Palantir stock was down 70+% from where those stocks peaked at in 2021 to where they troughed at the end of 2022 going into 2023. Those stocks were down like 70, 80%. No one wanted those stocks because you know why? The market was going down. The NASDAQ was down 35+%, right? The S&P 500 was down like 25% or so. So no one wanted Tesla. No one wanted Palantir. We're in the completely opposite situation. Everybody and their grandma wants those stocks. They're the momentum, right? But you know what they don't want? dividend stocks, value stocks. Look at how so many dividend stocks and value stocks have performed since 2020, that end of 2022. A lot have done horrible. A lot of value and dividend stocks I look at are down 20, 30, 40, 50% because no one cares to own those right now. It's not that the companies are suddenly bad. It's just people don't want to own those. They want the momentum, so they funnel their money into the momentum stocks, right? Guess where money starts to funnel once you start to get a downtrending market for any significant amount of time. Significant amount of time meaning 6 to 18 months. Guess what? Money starts to funnel right into the value and dividend stocks, right? So that's where you want to look at when the market starts to get really frothy. So where I'm going to be focusing a lot of my capital, especially if this market keeps going up in November, December, right? Let's say big tech earnings come out. These companies nail it. The market just keeps, climbing. Next thing you know, we got an S&P 500 well over 7,000. At the end of the day, I'll be starting to focus even more on dividend stocks and value stocks, right? Because remember also, when it comes to dividend stocks, those pay you out those dividends when the market's down, and then you're able to funnel that money into long positions of growth stocks. So you don't have to worry about like, oh, I want more capital to invest right now, but I have to sell a stock for that. That's no fun. But if the company's paying you out dividend money, right? You got a bunch of dividend stocks in your portfolio, they're paying you that out regardless. Like if you own great dividend stocks, it doesn't matter if you're going through a recession. It doesn't matter if the stock market's crashing. They keep paying you out those dividends every 3 months. Credits just keep coming into your portfolio, keep coming in, and then you're able to buy great growth stocks with those, probably at cheap valuations, right? Would you not like to buy Palantir at $7? Would you not like to buy Tesla at 100, right? Would you not like to buy Shopify for $25 in 2022, right? What about Netflix at 170 in 2022? Would you like that? If you had that dividend money coming in your portfolios, you were able to buy, right? Next thing up here is if you're a big dog, hedge, right? Big dog meaning you've got many years of experience in the market. You also have a massive portfolio. You can hedge. There's a lot of different strategies. I go through those in my private group in some of the curriculums. I think even one video is like 50-minute video just explaining different hedge strategies, but you can buy puts, right? In the money puts, you can buy out of the money puts. You could even make an argument that selling covered calls could be a hedging strategy as well, right? There's a lot of different other put strategies you can do. You can buy like inverse ETFs as well, right? Which is obviously something I did there. But you can also buy like a 2x leverage ETF against an index, right? You can buy call options on an inverse ETF, right? You can buy put options on a leverage ETF that's going on the upside, but you could buy put options. There's so many strategies you can do in regards to hedging, right? But that's really advanced stuff. Like I said, only if you're a big dog with a lot of experience and a lot of money in the market does that really make sense, at least in my personal opinion, right? Obviously, everybody's free to do whatever they want to do. It's just my 2 cents on it, right? So in regards to running numbers and running projections, right? Looking at 1000xstocks.com, this is my Palantir projections. I'm going to show you my bull case, base case, and bear case for Palantir, right? And I'll show you why it's made sense for me to cash Palantir shares like crazy this year, right? So I have them doing 40% on average revenue growth under my bull case assumption, 2026 to 2029. Going to be very difficult to do that, but we ran those numbers. 50% net income growth on average per year, 2026 to 2029, right? 120 to 140 P, net income margins of 42%. If that happens, Palantir still buy, right? Palantir would give me a compounded annual growth rate of around 20% roughly, if this scenario played out. But my bull case is usually only about, I would say, a 10 to 20% probability. My base case is much more realistic. My base case has them growing revenue 40% in 2026. I think that's a realistic number they can hit. 38% in 27, 35% in 28, and 30% in 29. Very strong numbers. Net income growth of 50%, 40%, 38%, 35%. Net income margins of 37% come 2029. 85 to 100 P if the company's in kind of more of the SaaS space, growing at those sorts of growth rates, right? I don't get a return. If I run my base case, and remember, those are great numbers. Like, how many companies could really put up those numbers that Palantir is going to put up over the next 4 years? Almost no one, right? If I can't get a return over the next 4 years, cash. You got, as hard as it is, you got to cash, because it's going to be a dead money stock for the next several years, unless that very low probability of the bull case plays out, right? What about a bear case for Palantir? That would be 40% revenue growth in 26, down to 35% in 27, 30% 28, and 25% 29. Keep in mind, those are still great numbers. Respect, right? 45% net income growth, followed by 40%, 35%, and 30%. 37% net income margins in 2029. How many companies in the world could do 37% net income margins? Not very many. There's like a handful of them, okay? 70 to 80 PE, which is high, but if you got those sorts of growth rates, you could command it. You're getting a negative return. That's why it makes sense to cash Palantir. That's why I sold the far majority of my shares of Palantir this year, because I've just run the numbers and the numbers say, dude, got to cash. So that's what I do. So you might say, why didn't I sell it all? I got a little 1,000 shares left. Remember, I used to have 5,555 shares of Palantir on the public account, right? And a ton more in other portfolios. At the end of the day, the only reason I'm holding this last 1,000 shares of Palantir is just in case my bull case plays out. In that, let's call it 10 to 15% probability plays out. I want to have a little skin in the game just in case, because amazing companies sometimes do amazing things, and that would be pretty shocking. If this company could average 40% revenue growth 2026 through 2029 per year and 50% income, that'd be a historic run. Historic. Maybe they pulled off. And so that's why I'm like, let me just keep a teeny bit in it. So that's why I still have 1,000 shares on the public account, right? And I still have it as a position in the Patreon portfolio. But for the most part, it makes sense to be cash and shares because the 2026 through 2029 does not set up well for Palantir stock. It just does not, man. It's rough in regards to that, right? So sometimes you got to make tough decisions. That is what it is. Remember, folks, build a portfolio you're going to be proud of years from now, not just proud of for the next 2 months, the next year and a half or something like that. Build a portfolio that you're going to look at 3 years from now, 5 years from now, 7 years from now, and be very proud of. Stay focused on long term. This incredible wealth building opportunity out there, and we got to continue to capture that, right? Pin and comment down there here today if you're looking to apply, join Private Stock Group, Private Wealth Group. Especially, you need to get in there ASAP if you have under $100,000 net worth, because you will not be allowed in starting next year. So keep in mind, what do you get access to? All of my course curriculums, every single one of them. My private Discord chat. You get access to 1000xstocks.com. You get access to see the moves I'm making, my $4 million plus Fidelity account. I made other moves in that portfolio here today, right? You get to track all that as well. Get to learn from me and how I run a big dog portfolio and all that good stuff. Much love and have a great day.